The markets and investors have been conditioned to look through volatility.
Markets can remain more buoyant.
On a fundamental basis, we are still in a very good place.
It's really not about hype anymore.
It's impossible to kind of figure out, like, pinpoint where it's going to go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, talks breaking down. The White House planning to block the Strait of Hormuz following the collapse of peace talks over the weekend. The tension sending crude oil breaking back into triple digits. It's a weak start to a new trading week.
Welcome back, although I should have said welcome back on Sunday night because we all were on our terminals on Sunday night trying to understand what the ramifications in markets would be from the biggest escalation since the ceasefire began. And a real question here about the market reaction. It actually isn't as great as I would expect because right now we still have the potential to escalate into a full hot war that brings in the entire region. The market's looking past that, saying earnings begin. We're not necessarily going to see that because that just doesn't seem to be in anybody's interest.
Equity futures right now in the S&P 500 negative just 0.6%. A fragile truce still holds. That's the good news. Are we taking one step back to take two steps forward? That might be the view of the equity market so far this morning.
The problem is, how does a fragile truce hold when you have the president at 10 a.m. announcing this blockade? The Iranians will not only not see this as the ceasefire holding, they will see this as an escalation. Basically, what the Trump administration is saying, if we can't use the Strait of Hormuz, or our allies in Europe and Japan and Asia can't use the Strait of Hormuz, neither can you.
Brent crude, triple digits, 102. What is anchoring the outlook? Earnings. Goldman Sachs later this morning, kicking things off 7:30 Eastern time. That is what we're pinning the hope on, that the outlook for earnings is still solid in America. The banks first to report.
Yeah, and this really is the reason why Morgan Stanley's Mike Wilson is still bullish and why Max Kettner of HSBC came out this morning saying he is still max bullish, max overweight, given the fact that earnings are likely to come in strong. Key question for me is, how strong does the outlook have to be, given the black box that people have of the outlook? How are they preparing for a world in which suddenly free shipping is not going to be the reality anymore? And that ultimately is the question that a lot of CEOs are going to have to answer.
Max is joining us later this week. One line in his research that he published just moments ago: less bad is good enough. Less bad is good enough. After the weekend, could you say things are getting less bad?
I'm not sure. I don't think so. I think that right now, potentially, we're just at a standstill. Nothing has moved forward or backwards. The talks are deadlocked. I don't see Iran or the United States moving on their very hardened red lines. And right now you have a blockade. So I actually view this as escalation because Iran says that they are going to respond to that blockade.
We've got a big week, a big hour coming up. Coming up this hour, Peter Tchir of Academy Securities has failed peace talks drive stocks lower. Norman Roule of CSIS on blockading the Strait of Hormuz, and Andrew Hollenhorst of Citi as inflationary pressures continue to build. We begin this hour with our top story. President Trump vowing to blockade the Strait of Hormuz for all vessels that stop in Iran beginning later this morning. Our team coverage starts right now with Jabana Basechi in Dubai and Tyler Kendall in Washington. Tyler, first to you. Just what happens several hours from now?
Yeah. Hey, John. Good morning. Well, at this point, we did get confirmation from U.S. Central Command that this blockade starting at 10 a.m. Eastern will extend to all Iranian ports, though importantly, they say that the U.S. military will not impede any vessels going to and from non-Iranian ports. So technically not a full blockade, but of course one designed with some really big implications. President Trump here, of course, trying to limit Iran's leverage and financial lifeline after the talks this weekend concluded without any resolution. President Trump also says effective immediately, the U.S. is going to try to clear mines in the strait, may actually board and seize any vessels that have paid tolls to Iran, and is ready to attack in the event that Iran retaliates. Because as you guys were just discussing, we did get this statement overnight from the IRGC saying that if any military vessels approach the Strait of Hormuz, Iran is going to take that as a violation of the ceasefire. All of this happening because these talks did not yield successful results. And we should point out that a U.S. official familiar with the matter confirms to Bloomberg News that one of the biggest sticking points this weekend was that the U.S. delegation felt that Iran did not fully recognize that the U.S.'s main goal here when it comes to these talks is to limit Iran's nuclear ambitions and its program. Now, John, President Trump did say in an interview over the weekend he thinks that Iran will come to the table eventually when it comes to their nuclear program. Yet we are also getting these statements from Iran saying that they're going to hold firm.
Jemana, we've seen the statements from Iran, the reaction from the U.S. Where are Gulf partners? Do they support the blockade that this president's looking to push forward through?
That's, the million-dollar question here. Nothing has been explicitly released, but I did spend a big chunk of yesterday speaking to many senior officials from the region, and they will tell you that this actually is an outcome that they would endorse, because we were in a situation the last couple of weeks where the only oil that was getting through the Strait of Hormuz was Iranian oil. Everything else, for every other producer in the region, it was essentially blocked off. And so now we find ourselves at least, with the U.S. trying to do something about the right of sovereignty that Iran insists that they have over the Strait of Hormuz. Again, as Tyler was saying, there's a lot of questions about how exactly it's going to be implemented, how Iran are going to respond, if this is going to lead to another downward spiral, would it lead to more military escalation and potentially an ending of the ceasefire. But I would say, and this isn't getting a lot of attention. One part of President Trump's Truth Social post yesterday, he did describe the meetings as having gone well and that most of the points had actually been agreed to. And so some people in the region are saying, well, maybe this is the masterstroke out of the U.S. And this is, I'm not putting words in other people's mouths, but I'm just saying there is a feeling that maybe this could work out in the sense that the U.S. managed to extract one of Iran's key points of leverage ahead of the next round of discussions. And therefore, they could be more amenable to yielding to some of the other U.S. demands, namely on the nuclear file.
Jumana Basechi, out of Dubai, Talakendo. Over in Washington, D.C., the talks continue. Is that enough for this market? This morning, the front month of the futures curve trading higher by about 8% in the oil market. WTI at 104, Brent crude at 102, and equities. If you just look at equities this morning, just slightly softer. Not seeing that big washout you might expect after the announcements over the weekend.
And part of the reason why is because the back end of the oil curve is still contained. You aren't seeing people really pricing the idea that this is going to be a material breach that will not get solved before December.
Futures this morning negative by 0.6%. Here is the view on Wall Street this morning. It comes from the team at Academy Securities, writing the following. This is a bold attempt to strip Iran of both leverage and revenue. This doesn't resolve the urgent transit problem. If anything, it complicates it. Pete joins us now for more. Pete, good morning.
Good morning, Jim.
Your reaction to that very subdued reaction in this equity market?
It seems about right. I was guessing we'd be down 1%, so we're not quite down that much. But again, I think people have to see how this plays out. To be honest, I think at 10 a.m. we will see what the military actions actually look like, right? It's a political action when the president talks about it. It will become a military action. We'll see what we're willing to do. Again, there's been talk about going into the strait and clearing mines. That would be awesome, right? That would set the stage for something really good. The flip side of that is we don't know what Iran will do, and we don't know what we'll do if, Chinese ships are coming through. So there's a lot of uncertainties. I think this could go either way still.
Militarily, and you and the team over at Academy in a position to help answer this question, how difficult is it to block the Strait of Hormuz?
I think that's well within our capability, right? Blockading it and keeping control, interdicting ships, that's something we can do. I think we can stay far enough away that we're not really in constant range of Iranian attacks. The flip side of that is, can we go into the strait and clear the mines? We supposedly would send 2 ships through. They did some mine sweeping. That could be more difficult. So I think it really comes down to the extent of how far we're willing to go and if Iran's going to try and disrupt us or not.
I spent the weekend worrying about China. And I wondered how much this was an effort to bring China into the play, because ultimately this would block some of their oil from coming to their shores. How much do you see this as an escalation in terms of international relations and trying to draw in other members more aggressively into this conflict?
Yeah, so one, I do think we're pushing on Iran and their economy. We'll see how long they can go with this. There is this risk of escalation, though, that you draw China in or you do something to a ship that all of a sudden in international waters causes some degree of legal consternation. So there is a risk. And I think that's been the problem, this kind of, the maximalist leverage that we're trying to apply. And Iran seems to be applying. It's very easy to slip and make a mistake and go down a path that you don't intend to, right? So I think that, to me, is the risk. And anytime you have navies out there, Air Force out there, there is a risk of accident or, Iran getting lucky, shooting down another F-50. So it's a risk, and I think it's nerve-wracking.
When I hear that, I think, why isn't the market down more? To John's point earlier. At the same time, earnings coming up are supposed to calm all, given the fact that the outlooks are probably going to be muted. That said, the actual results have been pretty aggressive and good. How much are you expecting them to comment on the tail risks and the potential scenario analysis of how they plan to face off with it?
So one, I do think all bets are off. If we really see the ceasefire broken, I think markets sell off 2 or 3%, right? So far, we have not seen the ceasefire broken. There's talk blockade. Away from that, yeah, I think people are talking about the tail risk, the uncertainty. And I think it's not even just going to be the U.S. economy. I think, what does global demand look like? Asia has been hit far worse than us by this. Europe's getting hit far worse than this. And finally, does the American brand sell as well globally? Are people seeing a willingness to buy American brands? Has that changed at all? So I think it's really going to be, what is the tail risk? What's the economic uncertainty look like? Again, just domestically, we actually, I don't really trust University of Michigan consumer confidence very much. But having said, an all-time low is still pretty, you've got to at least pay some attention. And uncertainty breeds conservatism in terms of spending and hiring. And that, I think, is the risk. So I think I really don't care that much what this quarter looks like. It's the sort of message you get out. And if Jamie Dimon's any hint, right, you are going to see more and more, concern about geopolitics, what this means. I can certainly tell you at Academy Securities, we've been incredibly busy as people want to understand how we're seeing the military play out. And as much as we talk about Iran, I would still say at least 50% of our conversations about China, because that is the real long-term strategic risk.
With great respect for Jamie Dimon, much of the Dimon doom has been pretty off base over the past 5 years, particularly with regards to JPMorgan earnings themselves. So I'd park that story just for a moment, and I'd raise this question: regret and conditioning. April 20, April 25. We'd be conditioned to buy the dip quite aggressively, and we're filled with regret if we didn't get long quickly enough. Is there a big difference between this moment and those moments?
One, I think April 2020, to me, that just seems so overdone. The fear was, palpable. It was wrong. We kind of got very bullish there. On Liberation Day, we were a bit slow to turn around. But again, that was one where we pulled back on all our policies, right? So you still have to read today, everyone who said, tariffs were going to be awful weren't right. It's like, well, we pulled back so much. This one's harder, right? It's harder for us to walk back. I don't even know what happens if we just say, hey, we're done. We fixed enough of the regime. We've moved on. We can leave the area. I don't know that we rally again like this. I feel like there's been more permanent damage. Again, there is this real risk. Everyone's been quiet. Everyone seems to assume no one wants to be caught short or not long enough when we get the real peace deal. And I think that's a risk right now, that we don't get that we once again see some degree of escalation. It's not a huge risk, but I do think that's real.
Does the market at this moment even believe a blockade's happening at 10 a.m.?
I think we're viewing it as simple. We'll stop ships coming in. Again, there's only 3 or 4 ships passing through anyway, supposedly. So this doesn't seem like that big of a deal. To me, I'll get really excited if we are going through and sweeping mines, because that would seem, hey, this is really pushing to a much more clear signal that Iran has no control over it.
To that point, Pete, there was also a New York Times article going into the weekend suggesting that Iran wasn't in a position to reopen the Strait of Hormuz because they didn't know where the mines were and didn't have the capabilities to clear them themselves.
Right. So there's also this risk that they have about letting ships through to potentially damage that they don't even want to happen. They don't want that. Then there's no intention for them to damage. They just lost track of where they dropped all these mines.
Jemana, on that line over the weekend that talks went well. Do you think we're in a position to sit here on Monday morning and say we're in a decent position for further talks here, further negotiations with the Iranians?
Mixed. I think it really comes down to the highly enriched uranium, right? Are they willing to give that up? I think militarily it's very difficult for us to get in. And the mines are an interesting story. It's, when we talk to our, generals and admirals in particular, mines are the one thing that really scare ships. Like drones, missile attacks, they're fine. Even some torpedoes. The mines are designed, they basically hit you from up, lift the ship up, crack it, and you're done. So it is a bit scary if there are mines floating around that no one knows where. Again, the U.S. military can do this. And I've been, if we see, for once, Europe or someone else come together and help the U.S., that would also be pretty positive for markets, right? We have not seen any help from anyone really in the Gulf or the NATO allies.
Well, Emmanuel Macron says they're hosting a conference this week, so we'll see what comes out of the European conference on the Strait of Hormuz. But Jonathan led into you by talking about the fact that this is a bold attempt, to your words, to cut Iran off of their revenues. If that's what this administration cares about, why did 3 weeks ago they unsanction Iranian oil?
That's a big question. I'm not 100% sure. And I'm on the slightly skeptical side that this will work as effectively. Do they have weeks or months of runway for this? Yeah, and we talk a lot about this, right? We've clearly been wargaming. We've been trying to practice, what we would do. Iran's been thinking about this for a long time. So you would have to believe Iran has some contingency plans for being cut off economically. Do they have side deals with China to get product in, even if they're not paying? So I really am skeptical that this will bring immediate, in the next week or 2 weeks, Iran to its knees from an economic standpoint. So if that's not the case, again, this is always still about this buildup. How long can we endure higher prices? And can Iran do anything to keep those prices high, which probably would have to include going back and targeting pipelines and alternative facilities. That's the risk of escalation.
It can get messy quickly. Final question. Pete, we're not going to have much time for this throughout this morning. Rory, back to back. Quick comment, if you can. What a weekend of golf.
It was pretty amazing. It was awesome how many people were in the hunt, and it felt like at any moment on Sunday anyone could have won. I'm glad Rory did. I really would have liked to see Cam Young win. We were at a watch party for him. It would have been awesome.
He's got a great future ahead of him. No doubt about that. Pete, it's good to see you, sir. Thank you. Peter Tchir there of Academy Securities. And, of course, congratulations to Rory McIlroy and his team. Up next on the programme, a standoff at the Strait.
Well, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that will be very effective.
Up next, we'll catch up with Norman Roule of CSIS, live from New York City this morning. Good morning. Later this morning, earnings season begins for the big names on Wall Street. Goldman Sachs kicking things off in about an hour and 10 minutes. Look out for that. Your scores heading into it. Equity futures subdued. We're down by just 0.6% on the S&P 500 following the biggest weekly gain of the year so far. Laurie Calvasina of RBC Bramo saying this morning. It appears to us that the S&P 500 has established a fragile foggy bottom.
Yeah, and still reiterating her target for the end of the year. We're seeing a similar kind of, I don't want to call it optimism, but an understanding that maybe we've priced in the bad news from Mike Wilson of Morgan Stanley, from Max Kettner of HSBC. How much is this where the gains have come from? It is big tech. It is the big banks reclaiming leadership after a long cycle of them really falling behind.
Just slightly softer on equities, even with this move in crude. And check it out. Brent and WTI back into triple digits, higher by anywhere between 7 and 8% so far this morning. Under surveillance this morning, it's a standoff at the Strait.
Remember, their promise was that they were going to open the Hormuz Strait. They didn't do it. They lied. As you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil, and that will be very effective.
So here's the latest this morning. Iran threatening to retaliate if the U.S. blocks the Strait of Hormuz to ships that stop at its ports, warning, quote, no port in the Persian Gulf and the Sea of Oman will be safe. Norman Roule of CSIS writing, it's the sharpest escalation since the ceasefire. This may not mark the formal end of the ceasefire, but it could represent the beginning of its unravelling. Norman joins us now for more. Norman, welcome back to the programme, sir. Norm, in your mind, what happens several hours from now at 10 a.m. Eastern Time?
At 10 a.m., in essence, you will have the United States stop all shipping into Iranian ports. And for the Iranians, they will need to test U.S. fortitude. They will likely try to do several things. They may try to run several tankers through the Iranian side of the Strait of Hormuz into Iranian waters to see what will we do. If the tanker captors are instructed to continue, no matter what the U.S. says, the Iranians will just see what happens. At the same time, the Iranians will look to see what ships go in outside under the U.S. control, and then perhaps threaten to target those ships or the ports where these ships attempt to dock. And last, of course, if the Iranian position is that their economy will suffer because of an inability to produce and export oil, they could, in an extreme position, attack Gulf oil producers.
Norm, is the blockade the appetizer potentially for full U.S. naval escorts through the Strait?
It is, but it may not, but it just may be a broader step for U.S. policy to test Iran short of hostilities. We saw the two destroyers go through over the weekend, and that was interesting for several reasons. First, they faced no mines. Secondly, they faced no Iranian missiles, speedboats, or any other Iranian hostile activity, which could have happened. Next, you had the U.S. demonstrate freedom of navigation, which is a long-standing U.S. practice in the Strait of Hormuz and the Persian Gulf. So you've got a precedent beginning where the U.S. is beginning to test a process that could lead to convoy operations. But it could be the convoy operations are not necessary. The strait just naturally opens on its own at some point. But again, we're in early days, and hostilities could well break out again.
Well, in these early days, will Gulf partners help the United States in this blockade?
I don't see that as being necessary, and the best way they could help out would be to produce oil and energy through other routes that don't rely upon the Strait of Hormuz, and I think you're seeing Saudi Arabia and the Emirates do this. Also, you're seeing rhetoric by the Gulf leadership, such as Dr. Sultan al-Jaber and others, where they state that no Iranian control of the Strait of Hormuz can be tolerated, and I think you're going to continue to see that quite clearly.
Norm, what left is there to negotiate if Iran doesn't want to give up control of the Strait of Hormuz and they are not willing to give up their nuclear ambitions?
Constraints upon their missile program to ensure that they don't develop an intercontinental ballistic missile, and continued enhancements on their medium-range ballistic missile that make it impossible or difficult for regional countries to stop them, but also the activities of the Quds Force. I mean, recall that the Quds Force was proliferating missiles to the Houthis, which did shut down the Red Sea for a period of time, missiles and drones. And there's no question that the Quds Force will continue to provide technology to the Houthis and other proxies in the region that will enable them to do similar things in the future. So for the United States, nuclear issues, missiles, and regional adventurism have always been the three issues of importance. And those issues have been shared by Europe and Gulf partners, but how they're handled has been the difference in terms of an approach.
How concerned are you that in response to the full blockade by the United States, Iran will get some of the Houthi militants involved in the Red Sea, and we could see a broader blockage of all transport in the region?
It's possible. However, the United States will likely treat the Houthis very harshly militarily. And I think you're probably seeing a lot of diplomatic efforts by the Saudis to constrain Houthi action. The Houthis have on-the-ground issues dealing with Yemeni internal matters that have also focused their attention. And traditionally, the Houthis have focused on Israel issues regarding Palestine, and their role has been limited thus far. So it's a possibility, but thus far a limited one, but it remains a possibility.
No, just a final question, because it's on people's minds. How do you think the US would respond if a Chinese-flagged vessel attempted to go through the Strait of Hormuz?
Intense diplomatic engagement with the Chinese to ask them why they are attempting to turn a regional conflict into an international conflict, and if someone in Beijing had actually lost their minds.
Norman Roule, thank you, sir, of CSIS. Norm Blunt, and to the point with that final reaction.
Well, ultimately, though, how much is everyone dancing around this? There were reports over the weekend that China was providing Iran with new anti-missile capabilities with respect to their air systems, also ideas of potentially China providing intel. So at what point is this really all a buildup to that May meeting between Xi Jinping and President Trump? And how do you create enough of an uneasy peace to keep that meeting on the books?
Looking at the markets this morning, there is a real buy-the-dip type feel coming from the research departments across Wall Street at the moment. Lisa mentioned the likes of Mike Wilson over at Morgan Stanley. This from BlackRock. We'll catch up with John Boivin in the next hour, turning overweight US equities on the AI theme. And perhaps more interestingly, with regards to what's taking place in the Middle East right now, upgrading EM equities to overweight as of today.
Yeah, I'm curious which ones, right? How much is this the energy exporters rather than the energy importers? Nonetheless, there is a feeling that a floor has been established and that people are overlooking the good news that we were focused on earlier this morning. And people point to multiples, the fact that multiples have gotten to the lowest levels that we've seen in a number of years, just simply based on the re-rating in a number of these names.
Equity futures negative just 0.6% to kick off a brand new trading week. Coming up on the programme, we'll catch up with Roukaya Ibrahim of BCA Research, with crude trading back above $100 plus. Christina Kino drops by with your morning movers. Energy stocks rising on the Hormuz blockade threat. Those stocks up anywhere between 2 to 3%. Equity futures this morning negative by just 0.6% on the S&P 500, following the biggest weekly gain of the year so far, and also following the first back-to-back weekly gains we've seen for 2026. Equity futures down across the board here. On the Russell, we're down by 1 full percentage point. Let's get some signal names and some morning movers. Let's cross over to Christine Aquino for more. Good morning, Christine.
Good morning, John. Of course, energy stocks in the spotlight today, leading gains in the pre-market as oil climbs back above $100 per barrel, and as we await the U.S. blockade of the Strait of Hormuz starting at 10 a.m. Eastern time today. Now, higher oil prices, not just the only impact of the war in Iran. ExxonMobil last week flagged a 6% loss in its global production in the first quarter as the war paralyzed operations in the Gulf. We're going to hear more about those details as the company reports its earnings on May 1st. We're also watching a NASDAQ 100 battle this morning. SanDisk coming out on top. That is going to join the index on April 20th, and it's riding high. Its shares hit an all-time high since it went public in February of last year. Now, of course, one company enters, another company exits. That is unfortunately going to be Atlassian. Those shares hit an 8-year low last week as pain continues for the software sector. Another software stock that we're watching this morning, Palantir, of course, it received a high-profile endorsement from President Donald Trump. The president praised the company's, quote, war-fighting capabilities in a social media post. Of course, those shares also getting bogged down in a software downturn. They hit a 10-month low last week, John.
Christine, thank you. Thank you for the update. More from Christine in the next couple of hours right here on Bloomberg Surveillance. On our radar this morning, President Donald Trump planning to block the Strait of Hormuz. The threat coming after the US and Iran failed to make progress in peace talks over the weekend. The blockade is set to take effect at 10 a.m. Eastern Time. Over in Hungary, Viktor Orban's 16-year rule coming to an end, the opposition party notching a landslide victory. Peter Magyar, the country's next prime minister, outlining sweeping changes to redefine Hungary's political ties. And finally, Goldman kicking off big bank earnings later on this morning. Analysts expecting the bank to benefit from a trading windfall fueled in part by volatility associated with the Iran war. We'll bring you those results in about an hour from now.
Yeah, key question is, how do they see the world going forward, right? How do they sort of hedge for increasing tail risks? And how much do they see companies still wanting to either go public, do mergers and acquisitions, issue bonds? How wide open are capital markets? Because right now, ultimately, the bulls on the street, what they're talking about is an inelastic demand from a lot of these companies to build out AI, to get bigger so they can be more resilient. How significant do geopolitical disruptions have to be to disrupt that? And I think increasingly that's what we're going to be looking for in terms of commentary from the big banks.
So the geopolitics might help in terms of the trading windfall, but it might cause a pause of things like M&A activity. What I find fascinating is that we're going to have the CEO speaking around 9:30. That's when their earnings call is. And 30 minutes later, their blockade, according to CENTCOM and the president, will begin. So it's going to be two interesting dynamics for Wall Street.
The calls might be more interesting than the results themselves.
Definitely.
There's another aspect dimension to the earnings from the big banks this week. Certain stocks like Goldman and Morgan Stanley have started to trade with a private market flavour over the last month or so. You read into that whatever you want, but ultimately they seem to be dragged down, held back by difficulties experienced by others over the past few months.
And they've come out and said that their private credit unit has been insulated because of their high institutional involvement. A real question here about how they try to differentiate their private credit units. But that's not the whole story, and I think you're pointing to that, which is essentially how much is their exposure to other private credit firms in the form of credit lines, et cetera, and then how much are they concerned about a broader credit cycle that private credit is just a node of, right? It's sort of emblematic of and is the sort of canary in the coal mine that they're seeing percolate into other sectors of their portfolio, in particular having to do with software.
That will be the main story in about 60 minutes' time. The main story, as things stand so far this morning, is this move right here. WTI and Brent higher by around 8%, crude surging back into triple digits as markets await the president's threatened blockade of the Strait of Hormuz. Javier Blas of Bloomberg Opinion joins us now for more. Javier, welcome to the programme. Let's just think this through, how this is going to work in practice several hours from now. What are you focused on?
Well, two things. I mean, how real the blockade is going to be. And particularly, I want to see if the U.S. Navy is really going to stop Chinese flag tankers getting out of Iranian ports and going into China. Is it that going to happen? Because to me, this blockade is targeting not just Iran. 95% of the Iranian oil is bought by China. So this blockade has two targets. Iran, economic pressure on the regime. China, perhaps sharing a bit of the pain, put a skin on the game for China, perhaps in the hope that it's going to put pressure on Iran to negotiate further. That's to me the two indications, not just focus on Iran, but also focus on China.
Javier, let's go to the map. You know the geography better than most. Just outside of the strait is an important Iranian export hub. How extensive is this blockade going to be?
I think it's extensive because the CENTCOM, the U.S. Navy, has said that it will include not just the ports in the Persian Gulf, that's probably meaning Kar Island, which is the largest one, but also ports in the Gulf of Oman or the Arabian Sea. So if that's the case, Jask, which is the port that you are referring, which is outside the Strait of Hormuz, will be also covered. That probably can export as much as 1 million barrels a day, but it seems that that's going to be covered. So on paper, the U.S. Navy could stop every Iranian oil tanker leaving the region, not just the Persian Gulf, but outside. And it will mean that just taking away between 1.6 and 1.8 million barrels a day of oil reaching the international market. So today we have less oil into the market than we have last week. Perhaps ironically, surprisingly, the price of oil today is still lower than it was a week ago, despite the rally that we have seen so far this morning and overnight.
Well, let's focus on the paper rally so far this morning. And Javier, the disconnect between the physical market and the paper market, which has been a feature of this war now for the last 5-6 weeks. You speak to the traders that trade the physical produce, Javier, the physical barrels. What are they telling to you about shortages emerging in places like Asia and perhaps across Europe as well?
There are certainly shortages of products, the refined products in Asia. There is also shortage of crude. And you need what we have called ASAP barrels. You need a barrel of oil for tomorrow for your refinery. You are going to have to pay a big premium over where the market is. That is more than a disconnect. It's the difference on timing. The paper market is reflecting barrels that they are needed in June. The physical market is reflecting the barrels that they are needed tomorrow in a refinery. Those barrels are very pricey, $125 a barrel and higher. We have seen oil changing hands at $150 a barrel for delivery almost immediately. The paper market is much lower, just above $100 a barrel. And to be honest, if you have asked me a few months ago where the oil market will be today, have all what has happened over the last 6.5 weeks happened, and going into a full blockade of the Iranian ports by the U.S. Navy, I would have said that prices much higher, not just much higher than where the paper market is. I would have said prices much higher than where the physical market is.
Yeah.
So all put, the price is not nearly as high as I thought it would be.
Javier, it's good to see you and appreciate your work as always. A clinic from one of the best there. Javier Blast out of London this morning. Roukaya Ibrahim of BCA Research writing the following: if enforced, the blockade would raise the risk of a breakdown in the ceasefire, an escalation in the conflict and strikes on regional energy infrastructure. Roukaya joins us now for more. Roukaya, welcome to the programme. Let's take it from the very beginning. The flows that were going through the Strait of Hormuz before this war started and where we are now, given the offsets from places like Saudi Arabia and the East-West pipeline, just how dependent are we on the Strait of Hormuz?
Right. Good morning. So, I think that based on our calculations, there are still about 13 million barrels per day that are locked in the Persian Gulf. That's accounting for, the bypass routes through Saudi Arabia, the UAE, the Iraq-Sehan pipeline. So there's, still a big chunk of global supply that's still locked in the Persian Gulf. Of that, as Javier pointed out, about 2 million barrels a day are still coming out of Iran. And so the risk now is that if enforced, the blockade then, also locks those barrels into the Persian Gulf and increases the amount of oil that is locked in the Persian Gulf from 13 million barrels per day to 15 million barrels per day.
Roukaya, how far are we from true shortages in Europe? I know we're talking about Southeast Asia is already experiencing that to some degree, but things like jet fuel, things like just basic natural gas, how far are we from that spreading more widely?
We're already starting to see a lot of that happen. There are already airports in Europe, for example, in Italy, that have announced that they will be rationing their supplies their jet fuel supplies. So we're already starting to see that happen. And as this disruption prolongs, the risk then is that, these shortages are going to become much more pronounced.
Roukaya, your line is a little bit shaky at the moment, so we'll re-establish that in the future and hopefully we can connect again. That was Roukaya Ibrahim there of BCA Research. To Javier's point, if we told you all of this ahead of time, maybe back in late February, that this is how things would play out through spring, this is the situation we'd be in, this is the US, this is what they would do, this is how the Iranians would respond, tell me where crude would price, where crude would trade. And not just the paper market, the physical market. I think a lot of people might have turned around and told you north of $200 a barrel. And that's certainly not where we are so far this morning.
And there are two reasons why. On one hand, people are taking a look at just how much there was a glut before this, right? A supply glut that was giving some sort of cushion to prices, and prices have been significantly lower as a result of the production. But the second thing is people do believe this to be short-lived, and they do believe this to get reopened, which is a reason why you're not seeing the oil curve really steepen out. It's actually deeply inverted, right? And this idea that down in December, we're going to be fine. That belief still holds, despite the idea that we could see potential escalation on a number of fronts.
Although Dr. Sultana Jabber, which runs ADNOC, was talking about the fact on Friday that the final ships that left Hormuz at the start of the war are now at their destinations, and there's not another fresh batch of ships going. This is also interesting. I know you're talking about Europe, but China, their imports from Saudi Arabia are going to be halved next month. So we might be on the precipice of the real physical crunch in the upcoming weeks.
I don't look at the futures curve as a great forecast, but I do see it as a source of comfort for a lot of people in equity markets, including the administration, because Kevin Hassett, the NEC director, keeps referencing it. If you look at where December is trading, it's still trading in the 70s. And I think that is a source of comfort for a lot of people in equities, which, of course, is an anticipatory asset class. And there is a belief that things won't be as bad deeper into the year. And for that reason, you can look through some of the physical stress. Now, the caveat to all of that is that that's been the story now for the last 6 weeks. And every week that goes by, you do real damage. And every week that goes by, it gets harder to ramp up production after this all ends, and if it ends anytime soon.
And it's not just oil, it's not just natural gas, right? I mean, if you talk about China, and it's not just a question of whether they're going to be able to power their factories because they have a lot of renewable energies, a lot of solar, a lot of nuclear. It's also the physical goods that go into plastics, that go into fertilizer, that go into all the material goods that people use. At what point do people start realizing that? I mean, I think to your point, there is a sense of comfort that this situation has been contained. What is the threshold to really cross that? And we'll keep gaming that out.
The EU Commission President is speaking right now, Ursula von der Leyen. This line here on just how much the fossil fuel import costs have gone up for the European Union. This headline, this number, 22 billion. Is the number coming out of the EU so far this morning.
They're talking about potentially cutting taxes. They're talking about other types of fiscal measures. A really interesting point that Carmen Reinhardt of Harvard Kennedy School came out with over the weekend is we're reaching the limits to which developed markets can really cushion the blow for a lot of their consumers just based on how much debt has been issued since the pandemic. So again, these are the reasons why, if you really want to take a look and get very nervous, there are plenty of reasons to. The market seems to be getting very calm. And frankly, I'm trying to get more signals from that rather than just go full histrionic.
It's a terms of trade shock for the Europeans. It's why euro-dollar is trading at 116.88 and not north of 120, as many people thought it might at the start of the year. Up next on the programme, a crude awakening.
This shock is large. It is global. Everybody uses energy. Everybody feels the pinch of prices going up.
Up next, we'll catch up with Andrew Hollenhorst of Citi, live from New York City. You're watching Bloomberg TV. If I told you overnight that crude would gap higher by 7 to 8% when you woke up Monday morning, is this what you'd expect to see in the equity market? Down just 0.6% on the S&P, likewise on the Nasdaq. This from BlackRock. We'll catch up with Jean Boivin in about 15 minutes' time. US-Iran negotiations collapsed for now, but we see talks as evidence of an economic incentive to end the conflict. We upgrade risk in the US and in EM stocks too.
Yeah, a number of Wall Street firms have come out and said that they're looking at multiples that have compressed substantially since the beginning of this conflict. They're seeing an opportunity because, guess what? We didn't see extreme escalation into more missiles flying. And you know what? Who knows something that they don't know that's going to get announced before that 10 a.m. blockade? So you know what? Why try to get ahead of it? Ultimately, look at valuations and get in when it looks relatively cheap.
Crude this morning up by 7%, 102 on Brent, WTI at 104. Under surveillance this morning, a crude awakening.
This shock is large. 13% of oil, 20% of gas that would have flown in the world is now stuck for 5 weeks and counting. It is global. Everybody uses energy. Everybody feels the pinch of prices going up.
So here's the latest this morning. Surging gas prices driving inflation to a 4-year high as the war with Iran upends global energy markets. Andrew Hollenhorst of Citi calling for 75 basis points of Fed rate cuts this year, writing, "We expect limited pass-through of higher energy prices to core inflation." Andrew joins us now for more. Andrew, good morning.
Good morning.
What was the lesson from Friday's data?
I think the lesson from Friday's data was really about where we were coming into this oil price shock. Of course, we saw the effect on gasoline prices, on headline inflation. But if you look through to core inflation, and again, we really have to watch this over months as we see, does this energy price shock transmit through? But we were in a pretty good place on core inflation. You look at that core CPI reading, 0.20% month on month. That's the kind of reading that we would have had pre-pandemic. And then you look at the subcategories, and I think that's even more important. Shelter, the supercore, services ex-shelter, and goods, all of those kind of in their usual pre-pandemic range. So I know it's not where we are. If we hadn't had these higher energy prices, I think we would have been looking at that inflation report and feeling pretty encouraged.
You're focused on the demand side of things. A lot of people are focused on the supply side and have been for the last 12 months. We've had negative supply shocks to labour, negative supply shocks to goods, and negative supply shocks to energy. And yet you're focused on demand. Why?
Well, I'm trying to be an economist here, and I'm trying to watch, do we see the effect on prices? You have a negative supply shock, but then how is that being balanced by demand? If we have strong demand, you're going to see prices moving higher. In the labor market, you'd see wages moving higher. But that's not what I'm seeing. If I look at the labor market, I'm seeing a loosening labor market with wages that are slowing. If I look at prices like we just talked about, it looked like those prices were slowing as well. When you think about that shock from energy prices, yes, it's a negative supply side shock that's going to raise prices for gasoline. But when you're paying more for gasoline, it means you have less money to spend on other goods. So I think it's actually going to be quite difficult for firms to raise prices on other goods.
Well, just to build on what John was talking about, you've gotten this issue. The Fed put out a paper last week or 2 weeks ago talking about how the big increase in core PCE over what it would have been has largely been due to tariffs. So tariffs drove inflation for a chunk of time. Now that seems to be waning. And now we've got this issue. I mean, at what point does shock upon shock upon shock create just a baseline inflation that has to be higher that consumers kind of have to accept?
Yeah, that's the issue that central banks are struggling with, and honestly, I think we'll be struggling with for years to come. You get this series of negative supply side shocks, and even if each one is in theory transitory, you start layering those one on the other, and you get a more persistent period of higher, more volatile inflation. I think we live in a world of higher, more volatile inflation. In terms of this specific shock, though, like you were saying, I think we're starting to get the early signs that tariff pass-through, that passing through of costs to consumers, that is playing out and will abate by the time we get to the second half of the year. On the energy price shock, still early days, but it goes back to what you were talking about earlier, what John was talking about earlier. If the market believes that oil prices will be back down to $70 a barrel by December, then firms are going to see this as temporary. And in a world of slowing incomes, where incomes are being hurt by higher gasoline prices, I think it's just really hard to come out and raise prices.
How difficult is it to talk about the U.S. economy as a monolith? I mean, it's increasingly bifurcated, and people say, well, it's an affordability issue. And it is for maybe 95% of the population. But that 5%, 10% of the population is still spending. We're hearing that from Delta. We're hearing that from all of the airlines in terms of bookings and how much people are willing to pay. At what point can that keep inflation higher, even as a greater number of people struggle to afford everyday necessities? Yeah, you look at the aggregate data on things like consumer spending, and they look fine. And then you look at things like credit card delinquencies. Credit card delinquencies are actually elevated. So how do you reconcile these things? I think it's exactly what you're saying. You have this bifurcation between those who own real estate, own equities.
those prices have run up so much that that's really helping to support consumption and spending for higher income, higher wealth. And lower wealth, lower income households are struggling in this economy. Again, you would think that if we have a large contingent of the U.S. population that is experiencing an affordability crisis, which we hear about, then it is going to be difficult to generate a lot of inflation in that type of an economy, and that does create downside risk to the economy as well. So we can say there's been this negative supply shock to the labor market. We have a slower growth of population and labor force. But when you have hiring that's close to zero, and that's where we've been in recent months, or relatively close to zero, really difficult for people who are out of a job, for younger people who are trying to get their first job. So there are cracks in this economy. It's just that, to your point, there's some other kinds of tailwinds that are holding things up.
And inflation expectations ticked up when you look at the Michigan Consumer Sentiment Survey. I know a lot of people talk about how it's very political, but even for Republicans, the outlook was very dire. So we're going to see consumers just completely pull back? Could it be a self-fulfilling prophecy?
I think you'll see some pullback there, and you saw the sentiment numbers dive. You saw near-term inflation expectations rise. I think one thing that's going to keep central bankers, especially in the U.S. at the Fed, a lot more confident is the fact that those longer-term inflation expectations have stayed relatively contained. They did rise in the University of Michigan survey, but if you look at the market-based expectations, those have really stayed quite low. So another thing that's giving central bankers confidence here.
You won't get the demand destruction if they're cutting taxes. Another headline from the Europeans. We were talking about that address from the EU Commission President Ursula von der Leyen. Annmarie, looking at a proposal to lower energy taxes.
Because it's really hitting their consumers. And also when you look at energy in the European Union, it is very highly taxed, which is why it's always cheaper to get gasoline or petrol in the United States. They're doing this in May, though. We are in April right now. And individuals, and this is basically the presentation of the proposal, they need to maybe move a little bit quicker. And to your earlier point about what's going on in terms of the Strait of Hormuz, the reason why Europe right now is buying so much Russian LNG is because of this reason right here. It's just too expensive and they can't even get their hands on it.
That's the kind of move that could make things a little bit more complex for the European Central Bank and the ECB.
I would argue that for all central banks right now, how much are their hands tied by a fiscal response that's going to potentially increase inflation, because you're not going to let that part of the population just completely decline, because this is increasingly a political problem. So every lever that a lot of the developed markets have pulled on has been fiscal and fiscal spending, which is the reason why debt has increased to the degree that it has, and the reason why people are concerned about the response mechanism, both on the fiscal and the monetary side of things, if there is another economic downturn.
The Europeans have limited fiscal space, Andrew, that much is true. The US, though, we've been talking about the tax refunds now for quite a while in the US. Doesn't this shock meet a tax refund story that should lead to a cyclical bounce in its economy?
Yeah, you look at those tax refunds and it's about 30, 40 billion above where we were last year in terms of where we're coming in this year. And then you look at, 30% higher gasoline prices. How much is that going to cost the American consumer? About $30 billion over a few months. So it looks like those are roughly balancing out.
Andrew, good to see you.
Thank you.
Thank you, sir. Andrew Hollenhorst there of Citi. The flavour on Wall Street so far this morning increasingly is buy the dip in the equity market. And you see that in a price so far this Monday morning.
People don't believe the Sunday night shockers anymore. I think that maybe they're tired, maybe they're sick of it, maybe they've seen this movie before, but right now, increasingly, people are conditioned to say something's going to happen. Clearly, if no bombs are flying, there is a sense of ongoing negotiations, and we're going to get caught on the right side of this.
I got so many messages about Trump's blockade saying, until what? There's a truth Sunday night or at 9:30 a.m. when the market opens, 30 minutes before the blockade is supposed to take place.
Futures this morning, negative just 0.6%. Coming up next, John Boivin of BlackRock, Henrietta Treyz of Veda Partners, Chris Marinac of Brean Capital, and Al-Hussainy of Columbia Threadneedle. The second hour of Bloomberg Surveillance is just around the corner.
The president went into this thinking this would be a matter of weeks. It is turning out to be a much bigger military operation.
We are already living through the worst case scenario.
The U.S. is not going to allow Iran to continue to have this leverage over the Strait.
Now that we're in that nightmare scenario, folks want to believe it's going to end soon.
For Americans, there is no doubt that this spring is going to be a very different expectation than what they had before.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. It might be surprising to a few of you. Running down by 0.4% on the S&P 500. Likewise on the NASDAQ with this move in crude. WTI and Brent. Looks like this so far this morning. Both of those up this morning by more than 7%. 102 on Brent, 103 on WTI. Heading into this later on this morning, 30 minutes away. Bank earnings season begins on Wall Street with Goldman Sachs at 7:30 Eastern Time.
And it's going to kick off what people in markets right now are truly interested in, which is A, how companies have just done, and B, how they're going to navigate whatever is going to come up next. How much do they see companies still engaging in mergers and acquisitions? How much is this only emphasizing the need to existentially get into artificial intelligence, get bigger so that you can withstand any potential shock? These are the reasons why people still have confidence that earnings and capital markets activity will continue with whatever happens over in the Middle East.
That's what's been anchoring the bull case now all year throughout this war. The outlook for earnings from corporate America, and just maybe it's too soon to really find out what this energy shock means for earnings in corporate America, and for that matter anywhere else in the world. How much guidance can they provide later on this morning?
Well, it's challenging, especially when you get almost the administration talking out of both sides of their mouth. Just 3 weeks ago, they unsanctioned Iranian oil at sea, to then this weekend say there's going to be a blockade so no Iranian oil can get through. Well, which do they want? And the Iranians are coming out and they're saying that if the security of their ports are put in jeopardy, they are going to get after other ports. So this energy shock might get a lot more challenging starting at 10 a.m.
That blockade begins just 3 hours from now. Coming up this hour, we'll catch up with John Boivin of BlackRock on why he's upgrading the outlook for equities. Henrietta Treyz of Veda Partners as the US readies a Hollenhorst blockade. And Chris Marinac of Brean Capital as Goldman kicks off earnings season. We begin this out with stocks sliding as crude jumps on President Trump's plan for a US blockade in the Strait of Hormuz. Bloomberg's Jemana Basechi joins us now from Dubai for more. Jemana, describe what's going to happen 3 hours from now.
I wish I could tell you, John, exactly what's going to happen for 3 hours from now. But another deadline to anticipate, of course, for the region. Before I get to the naval blockade, I just want to reiterate something that Trump said himself in his Truth Social post yesterday, where he said that most points had actually been agreed to in these discussions over Islamabad, those marathon negotiations over the course of the weekend. But the one point that really mattered that was not agreed to was the nuclear point. And this was also echoed, I should say, by the Iranian Foreign Ministry spokesperson, who said that there were 2 to 3 outstanding issues. Now, obviously, one of them is the nuclear file, and we'll talk a lot more about that, I suspect, in coming weeks. The other one of them was the Strait of Hormuz, because the U.S. stance, and they went into these negotiations insisting on an unconditional opening of the strait. Iran reportedly said, we will only do that once these discussions are over, once, i.e., we've reached a peace agreement. Obviously, an outcome that is unacceptable for the U.S. and for many Gulf states as well. And so what the U.S. has announced yesterday, essentially, is their own naval blockade to block the blockaders, so to speak. And that goes into effect in a couple of hours' time. Lots of questions still about how it's going to be implemented, if they're going to follow the Venezuela model, if they're going to seize ships, if they're going to be monitoring, inspecting, how far along the lines of military action they're going to go. But then the other key question to that is how exactly Iran are going to respond. And already Iranian state TV are saying that the naval armed forces see this as a quote-unquote act of piracy, and that any attack on an Iranian port would then incentivize them to retaliate on other ports in the region as well. So we could see a further military escalation if that does indeed happen. But I should also remind everybody that the ceasefire is still being upheld. There have been no reported incidents in the last 24 hours. And both sides have come away from the weekend talking about some progress. So we'll see. The next 24, 48 hours are going to be crucial in terms of where this blockade goes. But I will just say that there is an element of cautious optimism in this part of the world that perhaps, this attempt by the U.S. to wrest back the strait may succeed in terms of furthering those discussions, because it would incentivize Iran to come to the table and provide more concessions away from their effective control of the Strait of Hormuz.
Escalate to de-escalate. We've heard that a few times with the President of the United States. Bloomberg's Jemana Basechi doing a tremendous job of leading our coverage out of Dubai and across the Middle East. This is a tense moment. We've got no idea what happens in the next 3 hours. You've got crude gapping higher by 7% on Brent, 7% on WTI, and yet equities are down by just 0.4% of 1%. So what gives? This is the view on Wall Street this morning. Jean Boivin of BlackRock writing, US-Iran negotiations collapsed for now. But we see talks as evidence of an economic incentive to end the conflict. We upgrade risk in the US and EM stocks. Jean joined us now for more. Jean, good morning.
Good morning.
Let's just start from the very beginning. After the news over the weekend, many people were looking for a washout in risk, particularly given the weekly gain we just had last week. Just walk through why things are so much more stable than anticipated so far today.
Yeah, I mean, this is a very volatile environment, and there's a danger to be trading the headlines by the minute. We've turned neutral risk, downgraded risk, on March 23rd. At that point, we thought, oil prices were, reset at very high, in the above 110 range. And in a world like this, if it's sustained, we don't see how equities and risk asset can perform. And so we downgraded risk. But since we've seen the ceasefire being put in place last week, we didn't expect that to be a smooth ride for 2 weeks. But the point is that the ability to at least have talks and reduce the tension for the time being, at least on the military side of things, to us shows that there are very powerful economic incentives at play that will shape the response of all the actors. I mean, it's not only about the US or Iran, it's also about China. And we think that this is evidence of that being pretty powerful for now. So that's what is behind that upgrade for now.
You're not the only one who's come to that conclusion. I'll put that there. How you express risk, though, is interesting. US equities, you could say, is anchored to the AI tech story. We can spend some time on that. The EM piece of this is interesting. The risk-reward in EM, given we've got absolutely no idea what's going to happen in the Middle East anytime soon. Why the EM piece of the upgrade too?
Just to start on the US piece of it, in this upgrade, we think it's risky not to take risk in this environment. If you sit out and you wait, I mean, it's going to be bad for our clients if we were to see some significant rally. There's a relative aspect to it, which is even if we are to see tension to continue, I think the US perform relatively better than other places. So that's the upgrade to the US, and the AI story being very powerful still there. On the EM side of things, we think that there is... we've been positive on EM more broadly, but I think Europe is very, more directly affected by this, so that's not as attractive from a DM perspective. US, as I mentioned, is more attractive, so that leaves EM on a relatively more attractive basis, and we see tailwinds behind. We don't think the dollar will be necessarily, going on a very strong. It's been strengthening, but we think this is in the context where we see a softer dollar than we've seen over the last few years. That still is a constructive backdrop for EM. And then within the EM, there are places like India and other places where we think that they are better positioned to, at the middle, at the junction of our mega forces like AI, digital finance, and the geopolitical landscape that might be easier for them to navigate.
Why isn't it a concern that a lot of the emerging markets, you mentioned India, I would also mention a lot of Southeast Asia and China, are energy importers, right? I mean, there's going to be a higher premium on a lot of commodities, including energy. Is that a potential headwind to that call?
It definitely is a headwind. Again, I think we want to think about this on a relative basis. But if we were of the view that we're going to see oil prices that stay or continue to increase from here, and that's the basis for this year, that would not be consistent with this call. So I think we are expecting here some de-escalation eventually, and it's not going to be a straight line. And that's the world in which we see some easing of the pressure that you would see in Southeast Asia and other places like this. But if, again, things will be in flux, we'll continue to monitor, but if we were to see, it boils down, the strait needs to reopen. And if it does start to show sign of reopening eventually, and we get visibility on this, I think that is consistent with the call. If it doesn't, then we'll need to reassess.
The nuances of the bullishness on Wall Street are really interesting to me, and it's not all the same. But for you and the team, it seems like a big part of the story is that valuations in big tech got really reduced over the past couple of months. You haven't seen it reclaim leadership. You haven't seen new highs for a number of months. And this is the main issue for you, that you're seeing the upside there because earnings are expected to increase by 46% in this quarter alone. How much is that really the driver of bullishness that has absolutely nothing to do with the Middle East and, frankly, absolutely nothing to do with the broader U.S. economy?
Well, I don't think we can avoid the Middle East, and the broad risk sentiment is definitely massively affected by this. But we think we need to look through the day-to-day noise. And again, I think in the context where there is potentially a path forward now for some talks eventually that lead to some de-escalation, then in that context, then I think the spotlight goes back to the earnings story and the derating we've seen. And I think we look at that as pretty attractive in a world where we would see the de-escalation. So I think it's not like you can forget about the Middle East, but if you think there's going to be a path over the next few months where we see more clarity of de-escalation, then that's exactly right. I think the earnings story becomes the main one.
But it's not just oil, as we've spoken about. What about the fact that helium, which is a key part of the hyperscaler trade, Taiwan right now has critical shortages of this?
It is a global supply chain shock, right? To your point, it's not about oil only. It's about LNG. It's about like a bunch of helium and other kind of inputs that go into a lot of the global supply chain, which is why it boils down to the Strait reopening. This is all it is about. And if we were again to expect this to continue and to see disruption, it's not only about oil. I mean, we would have like it could be one of the biggest supply shock we've seen, even to the level we've seen in the 70s.
But your call insinuates then that the Strait opens soon.
Yeah, so this is all predicated on eventually flow restarting, and we think there's going to be damage, right? Even with what's already in place, like we see a hit to U.S. GDP that is of the order of 0.3. Global growth will be affected. In Europe, it's more like between half and a full percentage point on growth. So there's damage that's going to persist. We think that if we see some de-escalation and the Strait reopening, then in that case, the earnings story and so on becomes the key risk driver. But yes, there is a scenario where this is a real supply shock. And in that case, if it doesn't reopen, we'll need to reassess that bullishness for sure.
For now, this market's itching to move on. Goldman reporting in about 20 minutes' time. Tomorrow, JPMorgan, Wells Fargo, Citi. The day after that, we'll hear from Bank of America and Morgan Stanley. What are you and the team looking for from the C-suite on these earnings calls in the next few days?
Yeah, I think we need to see some continued resilience. There's going to be stories potentially about the increased cost that has been starting to fed through. It's going to be interesting to see how much of this we've seen. But I think we're going to be in a mindset of like looking through right now that story, because that should be eventually resolving itself. I think we're going to be interested to see on the AI piece how much of stories there is around the efficiency gains. I mean, that's the part that still needs to be documented and to kind of justify forward earnings that will come to that. So I think these will be the two things we'll be paying close attention to.
John, it's good to see you. Thank you, sir.
Great to see you.
Jean Bavin there of BlackRock, upgrading US equities and EM equities at a very tense moment. We talked about the conditioning and the regret of not getting long quickly enough back in April 2020, doing the same thing again in April 2025. And you can feel a lot of people looking to get long early in this crisis too.
How many times can you get stung before you start to respond? I mean, it's fool me once, shame on me, you, fool me twice, shame on me. And there is that feeling right now in Wall Street. It's all predicated, as John kept saying, on the idea that the Strait does get reopened, although people taking cues from the idea that, yes, it is hardline rhetoric, but it isn't coming with the idea that talks are dead. So ongoing talks, a good sign, green light for Wall Street.
You got one right, Bramo. I was happy with that.
Thanks.
I was impressed.
I very rarely happens.
People stumble on that one too.
Well, that's the reason why. That's the one expression I'll get right. I will completely bungle every other one that I do today.
No, I never get them right, so I don't even try.
Okay.
Up next on the programme, choking the Strait of Hormuz.
Well, as you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil. And that will be very effective.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Earnings season upon us on Wall Street. Goldman Sachs kicking things off at 7:30 Eastern Time. Then a busy one through the week. Coming up tomorrow, JPMorgan, Wells Fargo, Citi. On Wednesday, Bank of America and Morgan Stanley. The scores. Into it all, look okay so far this morning. Equity futures on the S&P negative just 0.5%. Anchored by the hope that we can move on in the Middle East quickly. I tell you what, we'll figure out if that hope is misplaced or not, because at the moment that tension is still in the physical market, still in the paper market as well. Look at the oil market this morning. WTI and Brent so far trading higher by more than 7%. Brent back into triple digits. WTI likewise. Under surveillance this morning, choking the Strait of Hormuz.
Remember, their promise was that they were going to open the Hormuz Strait. They didn't do it. They lied. As you know, at 10 o'clock tomorrow, we have a blockade going into effect. That'll be 10 o'clock tomorrow. Other nations are working so that Iran will not be able to sell oil, and that will be very effective.
So here's the latest this morning. Iran threatening retaliation if the US follows through with a plan to blockade the Strait of Hormuz, warning, quote, no port in the Persian Gulf and the Sea of Oman will be safe. Bloomberg's Tyler Kendall joins us now for more. Morning, Tyler.
Hey, John, good morning. Well, U.S. Central Command has confirmed that this blockade that will start at 10 a.m. Eastern will extend to all Iranian ports, though importantly says the U.S. military will not impede any vessels going to and from non-Iranian ports. So technically not a full blockade, though still one with big implications if enforced. We still have questions on exactly how this will be enforced, though President Trump has previously threatened that the U.S. could board and seize any ships that have paid tolls to Iran, that the U.S. is also going to start to work on clearing mines in the Strait of Hormuz. Amid the major buildup of military assets in the region, it may be worth mentioning that the U.S. currently has more than 20 warships that could be deployed for this operation, including some amphibious assault teams. Now, as you've already mentioned, we are hearing that Iran will likely retaliate if the U.S. starts with this blockade at 10 a.m. Eastern. For example, we got a statement overnight from the IRGC saying that any military vessel that enters the Strait of Hormuz will be viewed as a violation of the ceasefire. Now, from President Trump's point of view, he's doing this in a bid to maintain leverage over Iran, try to crack down on its financial lifeline after we saw negotiations this weekend not yield any result. Now, we are getting some breaking headlines on the terminal. The Israeli Prime Minister Benjamin Netanyahu speaking right now, saying that he has spoken to Vice President J.D. Vance, who led these negotiations, and that one of the main points of contention is that Iran will not allow the removal of that enriched uranium. They're still trying to figure out where to go from there. As John, a U.S. official does tell Bloomberg News that the U.S. delegation felt that the Iranian delegation did not see the U.S.'s main objective as being trying to curb its ambitions when it comes to its nuclear program. We can point out that in an interview over the weekend, President Trump himself did say that he thinks Iran will come to the negotiating table, and Iran's foreign ministry spokesperson added that it makes sense that they weren't able to come to an agreement after just one single session, leaving open the door for more negotiations.
The hope is the talks will continue. Tyler, thank you, and the ceasefire will hold. But that's not just a sticking point, Annmarie. That is the sticking point.
Yeah, when it comes to having a nuclear weapon, that has been the sticking point for Trump 1. That was also a sticking point for even the Biden administration that had talks for the entire 4 years with the Iranians. And then this administration came in and they've had multiple discussions with the Iranian regime. Now there's different players, but it's the same regime. They have the same goals as well. And at the moment, both of these red lines are hardened.
Here's the view this morning from Henrietta Treyz of Veda Partners. She writes the following: the blockade escalates everything. There's no acceptable outcome that maintains the Iranian tax or Iranian control of the Strait. Henrietta joins us now for more. Henrietta, welcome. The market mood, I have to tell you, is pretty subdued. Tense, but pretty subdued. Equities only down by 0.4%, 0.5%. How tense do you think things will be in the next 24 hours through the Strait of Hormuz?
I mean, as the Strait perpetuates and stays closed, I mean, how do you get non-Iranian ships through, but the other ones can go through? You hear directly from the insurers. They just don't have comfort that you can physically traverse safely. And there's 230 ships that are trying to get through, and some of them are turned around. There's one trying to navigate right now, from my latest understanding. As long as the Strait is closed and we're no longer getting flow as of this week from pre-war, you're going to start to see the economic effects compound. The Strait is optimistic, I think, in large part because they don't have guidance from earnings yet. We're going to get banks, this week, but that's not really the hard hitters. We need industrials. And the worst case scenario is sort of unfathomable. So we're sort of jumping right over it. But the insurers have the best points per usual.
Henrietta, it's not just the blockade. On Friday, after 12:01, I didn't see an extension from OPEC on the general license for individuals' ability to purchase Russian crude. So how tight is this market going to be? And do you think because of that reason, Treasury will have to give certain waivers to certain countries?
I am in a fight with somebody that I've been in for decades about what is more important, tax policy or energy policy, and tax policy wins again. So here we are. We have this situation where they want to have a toll that gets collected through the Strait of Hormuz, and the tax itself is illegal. And if you pay the toll, which is obviously a willing development, and you allow the ship to go through, then now not only the insurer, but the tanker itself is violating U.S. sanctions laws that J.D. Vance was not able to negotiate for obvious reasons in Pakistan this last weekend. So you have a situation where the tax itself is the core problem. You cannot allow the tax to be collected and also continue to have a sanction in effect and declare
But Henry, how does that even make sense? Because OFAC right now, technically, and until another week or two, is allowing the purchase of Iranian crude if it was at sea.
If it's at sea, and that's the key distinction, and they're purposely being murky about this. But if you pay the toll, which is different, that's trying to go through, then you are violating the sanction. And it carries a double fine of whatever it is that you paid. So if you're paying $2 million to get through, you owe Uncle Sam $4 million. And it carries with it a potential lifetime imprisonment should anyone die on the route. So there's two different things. There's allowing it to go through under the GMU from March 20th, and then there's paying the toll, which is a different animal.
In the meantime, there's a real question about the fiscal levers that the U.S. can pull. We've gotten headlines from the Europeans this morning saying that they're thinking of removing some of the taxes or lowering the taxes tied to energy. What kind of fiscal response could there be from the U.S. side of things?
Yeah, really great question. So Republicans are working on a reconciliation bill. And because the scale of this bill could escalate dramatically and end up in the $700 billion range or above, that's what history suggests. They're purposely telegraphing that it's going to be tiny. And it's only going to be associated with like ICE and DHS and those kinds of components. But we know that there is an 18.4% gas tax paid at the federal level and a 24.4% diesel tax paid at the federal level that they could suspend via reconciliation. That is a perfect bird rule applicable component that could get their reconciliation package, but it's very expensive. And we have a perfect case study in Georgia, which just approved this since the start of the war. And guess what? Prices in Georgia are right back to where they were before they did the gas tax. And that's because prices continue to go up. So it's a temporary stopgap. It doesn't solve the problem, as all of your guests have suggested.
Henrietta, always good to see you, to get your thoughts. Thank you. Henrietta Treyz there of Veda Partners. The mix right now, the data has not been great, particularly on Friday, heading into the weekend. Had CPI come in at the hottest level we've seen in several years. At the same time, you, Mitch, whatever you think about you, Mitch, I think direction is probably correct. Consumer sentiment, record lows. Consumer sentiment is clearly softer after this war and the higher energy prices we've seen over the last month.
Clearly, they're concerned about inflation. They're also concerned about jobs. I mean, to Andrew Hollenhorst's point, to that point, you're not seeing the same kind of heat coming from people's perception of whether they can get a job and whether they can continue to get paid, certainly not at the level that would compensate them for inflation. So what's the fiscal response? And how much is the U.S. limited by how much debt it has incurred over the past couple of years?
Earnings season begins on Wall Street.
Yes.
You happy with that? Green light's just gone off. Goldman Sachs.
Yeah, they're ultimately beating, and that's the issue, right? How much are we going to keep on seeing this across the board going forward? We'll break down all the numbers, but beating almost across the board. FIC, maybe not, but the rest looking really good.
We'll spend some more time on Goldman in just a moment. Danny's going to break down the numbers with us. Plus, we'll catch up with Chris Marinac of Brean Capital as Goldman kicks off earnings season, a week full of earnings from the financials. From New York City, you're watching Bloomberg TV. Snapped a 7-day winning streak on Friday in the equity market. Just a touch of negative follow-through this morning. We're down by 0.6% following the events over the weekend in the Middle East. On the Nasdaq, we're down by 0.6. Also, on the Russell, we're negative by 0.9. First out of the gate on Wall Street, it's Goldman Sachs. Earnings season begins. Danny Berger has the results. Morning, Danny.
Good morning, John. It's the headline number that's going to catch everybody's attention. A huge beat for equity trading, $5.3 billion. To be clear, this is a record in a quarter, not only for Goldman, but for any bank ever on Wall Street. It beats its prior high water mark by $1 billion. You can see, though, shares are off nearly 0.6, or now more than 1%. This might be the reason, because even though they have a huge beat when it comes to equity tradings, a huge miss when it comes to their FIC expectations. $4 billion as revenue is what comes in for FIC trading. The estimate was closer to $5 billion. So they're off by about $0.8 billion, which is a disappointment for this market because many had expected equities trading revenue to be strong. Elsewhere, M&A results, advisory fees 89% higher than this time last year. We knew it was a record quarter for M&A for the entirety of this market. So Goldman Sachs earnings reflecting that too. Their global banking and markets net revenue comes in just below $13 billion at $12.7 billion. That is a beat. Just looking for anywhere in these results, you might see some credit fears. Provisions for credit losses did go up about 9-10% over year at $315 million, but we have certainly seen it higher in prior quarters. In their asset management, you did see AUM beat expectations, $3.7 trillion. Goldman Sachs had said that they were immune from most of the fears of private credit selling that you've seen in some retail funds, though net revenues did fall compared to the same period last year. Also, a note of caution when it comes to the geopolitics in this earnings as well. The geopolitical landscape remains very complex, so disciplined risk management must remain core to how we operate. Shares, though, continue to fall, John. It seems to be that FIC miss, a dark spot on an otherwise solid earnings result.
Stock is down by more than 2% of the pre-market. Danny, stay close. I'll come back to you in just a moment. Just to break this down very quickly, stock trading comes in much firmer than anticipated. Another record. Danny went through the numbers. Just think about this. The record in the previous quarter was 4.31 billion. The record now is 5.33 billion. So that's the good news for Goldman. The miss is on FIC, and we can talk about that extensively throughout this morning. Where there is also some strength, and Danny talked about it too, that 89%, and let's call it surge, in deal-making advisory fees speaks to a theme that a lot of people were jumping on board for coming into this year and why this part of the market was a consensus overweight.
It's mergers and acquisitions, it's corporate bond issuance, it's IPOs, and when you take a look at equity underwriting, debt underwriting, both beating by a significant margin. If you look at equity underwriting, it's up 45% year over year in terms of the fees that they're receiving. So capital markets wide open, the banks profiting off of this. The concern going forward really speaks to what David Solomon is talking about. Their conditions are uncertain. Key questions in the call. How is that affecting the forward pipeline of M&A? Is it falling away or is it continuing to be strong? And how high is the bar to close capital markets? Because right now it seems like they're wide open. So yes, they might be missing on the actual transactions in FIC, but they're certainly not missing in equity. And there still is this pipeline that a lot of people say continues to build.
And Danny, just quickly, I want to bring you back in. You mentioned the credit story, and this is important for a lot of people outside of this stock, just trying to understand what's happening here. Because this stock, in the minds of many, has been held back by what's been happening elsewhere in private markets. And we started to see that in Morgan Stanley and the way it traded as well. What have we learned so far this morning?
Well, again, it seems like strength. The asset management division, where maybe you would see some of the credit fears play in, they did indeed beat an AUM. If you did have people pulling back because there's a fear over private credit, that's where it would show up with less fundraising and less assets managed. Now, again, we've heard from Goldman Sachs recently, just last week, saying that GSAM's BDCs, they're more private, retail-oriented private credit funds, have fared better than others. And again, loan loss provisions, those were higher than last year, but nothing out of the norm. And again, it's notable that in David Solomon's comments, he talks about geopolitical risk. If you were to get anything from the CEO of Goldman Sachs concerned about private credit, you might expect it to show up there. We'll see what he says on an earnings call, but it doesn't seem to be bubbling anywhere near the surface as concerns for this big bank.
Danny, appreciate the update. Danny, thank you. Goldman down by, let's call it 2.7% in early trading. Chris Marinac of Brean Capital joins us now for more. Chris, welcome to the programme. How difficult is it to anchor the outlook in a moment like this?
Well, John, I think that you may have trading losses in FIC, and that might be part of the problem. So I think as you move forward, this may not be as big of an issue. I think the pipeline being very strong on the banking side is very important. So I do think that is a win in the quarter. I still think that seasonally the second quarter is also very strong. So I think the market can look past this disappointment initially.
Do you have a sense of what David Solomon could be talking about when he said that he had seen some concerns? He's worried about geopolitics. What are you looking for in how he speaks about that to get some guide on when it could hamper some of this capital markets activity?
Well, I think it's things that are not announced that are in the works. And I think that there tends to be an attitude to go on hold when you have this geopolitical uncertainty. And that's the part that you can't account for. So I think as May and June come into greater focus, I think there is a high uncertainty. And I think he is trying to give a signal that that indeed may be the case.
high uncertainty is part of what he might be pointing to when you take a look at the 10% build in provisions for credit loan losses, which is something that we heard Danny talking about. Now it's $315 million. Is that number significant to you, or does that signify still a pretty benign credit backdrop?
Well, I think the credit has its own uncertainties, particularly in the private credit world. I think you have to build reserves now just to be safe. So I think the attitude about having higher provision is smart. To some extent, I think the market would be disappointed if you had not built reserves at this juncture.
At this point, though, is that a significant build, right? I mean, I guess I'm trying to get some perspective on this. Does that indicate that they're really concerned about stress? Because right now you're not seeing it in any of the preliminary comments. But this is the fear. Aside from private credit, it's the broader sense of re-rating in specific wholesale industries in the credit area, particularly tied to software, disruption trade, et cetera. I mean, how much would you expect loan losses to have to increase to truly offset some of that potential risk?
So I think it's a moderate build to your first question, Lisa, and I think going forward, I think you have to have a significant change in credit losses to really warrant much greater concern. I think right now it's a preliminary move to be conservative, to placate, I think, investor concerns that perhaps the companies aren't doing enough. So I've expected to see some provision increase this quarter, so I'm not that surprised by it.
Chris, this year we were meant to see a boom in economic activity, particularly the kind of boom that some of these names would take advantage of. We still might see 2 or 3 of the biggest IPOs we have ever seen in the history of capital markets, Chris. Which banks are in a position to take advantage of that?
Well, clearly the national leaders from the JPMorgan and B of A and Goldman should have that. I think those big IPOs are still out there. I agree with you, John. It's a long year, so I would not give up hope at all. I think this uncertainty can pass just like it did last year. So I still think there's a very good road ahead.
Are you willing to look through some of the gloom that might take place on some of these calls, Chris? No executive wants to be dismissive of risks that might be brewing. Not a single executive on Wall Street wants to be the person that does that on these earnings calls. Do you think they might really understate the potential for gains in the year ahead? And I'm not just thinking of Solomon later, I'm thinking of maybe Diamond tomorrow.
Oh, sure. I think they're going to be very careful and cautious, no different than they were in April of 2025. You know, we had Liberation Day and then markets were very uneasy for several days, as you remember. And most calls were very sort of quasi-negative and cautious in April of 25. It turned out to be a much better year as the second quarter played out. So I think this could be a repeat, just totally different circumstances.
Chris, is it basically a quarter where numbers could be pretty solid, but the rhetoric is concerning given what's going on in the world, so that shares ultimately just are depressed?
Well, I think investors always hit the sidelines when you have uncertainty, and I think we have that moment. They acted better last Thursday, Friday than I would have thought, quite honestly. I do think the rhetoric could keep the incremental buyer holding back in the short run.
So the stock right now is trading in pre-market on this FIC miss, and I'd love to get your sense of why you saw such a big miss when it comes to FIC sales and trading. A real concern here is that interest rates are going to be higher and that potentially incredibly volatile, making it really difficult for big banks. How much of a headwind is that? I mean, are we skipping over that too quickly?
Well, I think people had thought that the Fed would be easing once or twice as we got into the second quarter. That obviously is off the table. So that is part of the headwind. I think to some extent the uncertainty about whether the war is going to go away or still be lingering for the next 4 to 6 weeks also is a concern. I think to some extent there was a lot of optimism built into this quarter from a trading perspective. So now that you have a slight miss, that pushes everybody now to be negative. I think that's a short-run thing. I think we still have a lot of positivity happening in the business. You know, on the ordinary bank side, the deposits are growing really well, and that's ultimately going to have many players buying securities as this next 2 quarters play out.
You know, volatility is a funny thing. On one hand, volatility can be really good for the banks, and they'll say, well, we benefited from the volatility. You see this in equity trading. On the other hand, it can be bad when it is just an unpredictable macro environment. Are we entering bad volatility or good volatility? I mean, what do you expect the commentary to be from the big banks?
Well, most of the volatility, I think, is positive. I think the companies understand how to make a dollar when you have these topsy-turvy markets. They've been here before. We've seen many examples of volatility the past several years. So I think it's just a different circumstance, but the same volatility. To some extent, I think volatility is your friend. But you may have had a loss of the Goldman quarter, and I think as we see the other players come out the next couple of days, it may look and feel a lot different.
Chris, it's always good to hear from you. Chris Marinac there of Brean Capital, just setting the tone for earnings season ahead of us. We just heard from Goldman. Tomorrow you'll hear from JPMorgan, Wells Fargo and Citi. The day after, on Wednesday, you'll hear from Bank of America and from Morgan Stanley. It's not a tremendous start for the financials. It's mixed, which isn't great, particularly given that so far this month, Goldman was higher by something like 7%. It's trading lower this morning by 3 to 4. The good side of things, equity trading, deal making, advisory fees, fantastic. The soft spot seems to be fixed so far this morning.
Yeah, they still beat, though, on the EPS. They still beat pretty much across the board, as you're saying. So does this indicate how high the bar is right now for earnings, in a way, given the fact that the entirety of the resilience in the equity market is predicated on this idea that there's going to be a really strong feel and the beats are going to be much better than people had previously expected? The fact that people are so nitpicking, again, that tells you maybe where we are and the expectations that are baked in to the stock market.
To Chris's point, we played this game 12 months ago. We're in a position where a lot of people are looking for earnings to anchor the outlook, for guidance from the C-suite to give you some visibility. And no one in the C-suite wants to really express any real confidence about the next 12 months, given the real risks they're seeing take place on the ground in the Middle East. And that was the story of April last year. And that wasn't a good guide for the direction of equities. And the argument you'll get from the bulls, misplaced or otherwise, that's your judgment call, but the argument you'll get from the bulls this morning is they can't provide any optimism in a moment like this. So why would you listen to them?
It would be incredibly tone deaf for them to come out and say, this is incredible, volatility is absolutely rocking us, and we're doing a really good job. We're going to have record earnings. We're seeing incredible mergers and acquisitions, although likely we will hear more of that. So, yes, you can expect some dampened enthusiasm. That said, if they give a sense of the pipeline being strong, of deals still going through, of some of those mega IPOs that we're expecting later this year to still come to market, does that assuage some of the concern? I don't know. I mean, really, this is going to be scenario analysis. And I keep going back to that. What's the potential bear case for you? What's the potential bull case? How big of a delta is there between that?
I also think, though, the C-suite needs to expand upon how they feel right now and where we are in the world. The geopolitical landscape remains very complex, so disciplined risk management must remain core to how we operate. You could print that on every single statement.
I've never enjoyed that phrase, geopolitical risk. Never really enjoyed it. Tell me about the flow of money, the flow of capital. The Middle East is a source of capital and destination for capital, and how that's changed and what you're seeing, what kind of visibility you have on those things. No doubt the analysts will ask those questions on the call a little bit later.
And no doubt the answer will be, so far, so good. They're major clients. I mean, who are you talking to at that point, too, right? You're talking to the U.S. authorities, but you're also talking to all of your big Middle Eastern investors, and you have to keep them happy. This is going to be a fraught moment, a lot of noise. Really look at the numbers, and I think that that is the key question. How much are we going to be watching money flows to really get the answers?
Goldman in the pre-market down by a little more than 3%. Up next on the programme, an inflationary shock.
For the Fed, you can look through a particular month, particularly driven by gas prices. Our baseline is that we will get a cut in the back half of the year, but kind of confidence in that has waned.
Up next, we'll catch up with Ed Al-Hussainy of Columbia Threadneedle, live from New York City. This is Bloomberg Surveillance. Earnings season begins on Wall Street. Goldman, the first name out of the gate. Goldman Sachs down by 3.5%. A bit of a stumble out of the gate. On the good side of things, equity trading, deal-making, advisory fees. On the bad side of things, FICC just softer than expected.
Yeah, and this really highlights the high bar for a number of names, especially those that are still trading at a relatively high book-to-value ratio, book-to-loan ratio, which is the reason why people are looking not only at what the earnings are, but what the expectations are, which for some companies have gone way down and others not so much.
As Goldman trades a little bit softer, lower this morning, the broader equity market does as well. S&P 500 futures down by 0.7%. The Nasdaq down by 0.7%. Also a chorus on Wall Street, though. From bank to bank, Morgan Stanley, JPMorgan, BlackRock, HSBC, take your pick. So many people lining up to say, buy the dip, get long this equity market. It's time to look through the risk in the Middle East.
And part of the reason why is because you haven't seen an escalation that really does shatter the ceasefire entirely, and talks are ongoing. Also because they've been fooled many times, and also because earnings season is expected to be really good. Earnings are expected to increase by more than 12%. You're expected to see a huge bump up, specifically in tech earnings as well as the banking earnings. They see capital markets wide open, so they feel like, you know what, we're going to miss out more on the upside than we are on the down.
We hear it every single week, then every single week. Speak to someone in the commodity space who gives you a reality check. about what's happening in physical markets.
Well, it's even worse today than it was, say, on Friday. At one point, you have OFAC basically not reissuing this license for countries, especially in Asia, to buy Russian crude. That's one. Two, there's now another blockade on the blockade. So any 1 or 2 or 3 vessels that were getting out, even if they're Iranian, maybe even going to a place like India, that will no longer happen now starting at 10 a.m. So today is much worse. And the final ships that left their destination have gotten there, and there's not another inflow coming in. China is halving the amount of crude they buy from Saudi Arabia.
Brent and WTI so far this morning back into triple digits and higher by more than 7%. Under surveillance this morning, an inflationary shock.
For the Fed, you can look through a particular month, particularly driven by gas prices. I think more important for the Fed would be core PCE. That is running at 3% year over year. It's a percentage point above their own target. The starting point is just not good when you're overlaying another energy price shock on top of that. Our baseline is that we will get a cut in the back half of the year, but kind of confidence in that has waned.
So here's the latest this morning. Surging inflation eroding bets that the Fed will cut interest rates this year. Ed Al-Hussainy of Columbia Threadneedle writing, the data overall leaves the Fed with a live option to execute an insurance hike later this year. Ed joins us now for more. Ed, good morning.
Good morning.
Enjoyed the note, so I'll share a bit more of it with our audience. We've had some early colour on the impact of the Iran war on inflation. Today's CPI print, Friday, is immediately relegated to the EFL. That's a different league in English football. Anyway, the Premier League is for data that can tell us whether some of the excess inflation we had at the end of last year is starting to broaden out and become entrenched. What are you seeing on that front?
I think the good news is so far, both inflation and inflation expectations have been pretty well behaved. Consumers have updated their short-term inflation expectations. They're expecting this gas spike to pass through into inflation over the next year. But longer term, things have been quite stable. And that's exactly what the Fed would want to see at this stage.
What do you think is going to anchor the Fed? Consumer expectations or market-based inflation expectations? Which is more important?
A little bit of both. The market-based expectations are a live tracker. They're the most immediate feedback that the Fed can get. The consumer expectations carry a little bit more weight because they're a little bit more connected to the real economy. So they need some mix of both to validate just staying on hold at this stage.
What components are you looking for that broadening out? Because we're seeing a number of different shocks layered on top of each other, and you could say any one of them are temporary or going to pass. At the same time, it starts to feel a little bit like, what are we doing if we're just excluding absolutely everything that comes down the pike?
I think the lesson of the COVID-era inflation shock is not to be too narrow in the inflation analysis. Look at momentum in the overall basket. Look at breadth of the overall basket. What share of the basket is growing at 3, 4, 5% on a quarter-over-quarter basis, for example? That's a much better indicator than a narrow view of what's going on in energy or what's going on in airline fares and so on. And again, I think the good news is at the start of the year, the inflation basket, the inflation process had narrowed a lot, really, over the last 2 or 3 years.
You say an insurance hike could be on the table. This is the bear case for all the bulls on Wall Street. If you take a look at their notes, if you look under the hood, the one thing that could torpedo their optimism would be something of a more hawkish take from central banks, particularly the United States. Why do you think that that's increasingly likely, given the rhetoric that we've heard from Fed Chair Jay Powell?
I think from the Fed's perspective, you want to keep that door open. It demonstrates credibility to the market. It anchors expectations further out on the curve. And it essentially tells the market, like, look, we have gone through this process just 2 or 3 years ago. We've reestablished our credibility by bringing inflation down. We're going to keep it in place by keeping our policy options open. You don't want to narrow those policy options at this stage.
Well, Jay Powell's term ends in 1 month and 2 days. Do we have insurance hikes baked in for Kevin Warsh?
The answer is no. And I'm not sure if his term is going to end in a month and a half. But look, at this stage... Technically. At this stage, markets are finding it really hard to price those hikes in the U.S. That door is much wider and open in the UK, in Europe, in emerging markets. In the U.S., we've had a debate between how many cuts and staying on hold. That debate could shift, again, if the inflation process accelerates. But if you're sitting at the Fed, you want to make sure that that door is slightly open.
I'm half joking, but I don't even know if Warsh's term is going to start anytime soon. We're meant to have a hearing.
Yeah, it's been delayed.
Why is that?
Punchbowl News says because of paperwork, which I find interesting because shouldn't he be doing his paperwork since Trump won when he wanted the job?
For 10 years. Yes. And you're telling me he doesn't have the paperwork ready?
According to Punchbowl, yeah.
That just sounds absolutely stunning, doesn't it?
Especially given all the other potential delays. I guess he thought that this would never end. He never expected to be at the top of the Fed.
Here we are. Ed, how do things change when Kevin Walsh gets into the seat?
I think things change on a couple of fronts. One, in the background, there's been a live conversation about the Fed's balance sheet. I think that gets reanimated in the course of his hearings. If we move forward with shrinking the Fed's balance sheet, what does that look like? What is the philosophy behind it? And what does that mean for the future of Fed policymaking with that balance sheet tool? The second, of course, is the short-term issue of take the productivity mix, the tariff shock, the energy shock at the moment. How do you make a case for cuts if you are Kevin Walsh? I think it's an extraordinarily difficult case.
Have you got an idea of how they'd present that case after a series of negative supply shocks across goods, labour and now energy? How you'd present that case this summer?
So one way to frame it up is to say, look, the inflation process, again, going into the shock was really well behaved. We brought down wages. If our theory of the case when it comes to inflation is that it's some interplay of expectations, wages, and productivity, on all three of those fronts, the news is quite good. Expectations are well behaved. Wages have come down. Productivity has gone up. That's a great case for easing policy on the margin. Now, that's keeping a lot of other things constant. It's not, I think, a complete case, but I think you have the makings of a case there.
Ed, good to see you. Enjoy the work as always. Thank you, sir. Thank you. Ed Al-Hussainy there of Columbia Threadneedle on some of the economic gymnastics that might be taking place later this summer when we finally get those hearings.
Yeah, if we get those economic gymnastics, I expect the Treasury to play a part in it because there will be some sort of Treasury-Fed accord to try to keep the long end of the yield curve lower. I mean, ultimately, how do you get any of this without leading to inflation expectations not becoming a bit unanchored? And I keep going back to what Cameron Dawson said, find someone to believe in you the way the market believes in the Fed's 2% target, because we have not been there for more than 5 years.
Pretty impressive, isn't it?
And pretty much everyone still believes we will get there one day.
I just can't believe his paperwork's not ready.
Who's he going to blame? The dog ate my paperwork.
He's been planning this for 10 years.
The baby.
And the paperwork's not ready.
And also, he was interviewed for the Treasury Secretary, so he should have had, he should have had the paperwork done in December.
Okay.
Medical form?
Right? I've got no idea. I'd love some details.
Haven't got to the doctor.
From the guys at Punchbowl News. Just, what are they talking about? What paperwork? Coming up, Jason Draho of UBS, Oksana Aronov of JPMorgan, Stephen Ricchiuto of Mizuho, Bob Elliott of Unlimited Funds. The third hour of Bloomberg Surveillance up next.
The markets and investors have been conditioned to look through volatility.
Markets can remain more buoyant.
On a fundamental basis, we are still in a very good place.
It's really not about hype anymore.
It's impossible to kind of figure out, pinpoint where it's going to go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Following the biggest weekly gain of the year so far, the S&P 500. Here's the pullback. We're down by 0.75% on the S&P. On the Nasdaq, we're down by 0.8%. And following the worst week for crude for the year so far, here's the bounce. WTI and Brent crude higher by more than 7% so far this morning. Anchoring the outlook for many, an equity bull, is the outlook for earnings. And the start of earnings season on Wall Street, not fantastic. Goldman Sachs stumbling out of the gate. That stock is down by close to 4%.
Yeah, and the real key miss here was in the FIC trading and sales unit. You saw that come in lighter than expected by almost 800 billion, by a significant margin, which led people to be concerned about what they might be missing. That said, on a broader level, the earnings beat expectations pretty much across the board with a record quarter when it came to equity trading and sales. So at a certain point, does this indicate the bar is incredibly high, given that this is the linchpin? The earnings is what is keeping this market from falling much more. If earnings do not beat expectations to the degree that people expect, how much does that remove one of the pillars that's been upholding this market?
JPMorgan tomorrow. The day after that, we'll hear from Bank of America and from Morgan Stanley as well. How much guidance can they provide in a moment like this one? How much guidance do you have, visibility? Never mind in the next 9 months. How about the next 2 hours? 1 hour and 58 minutes. A blockade of the Strait of Hormuz begins at 10 a.m. Eastern Time.
That's according to the president. It's according to CENTCOM. I got a lot of messages over the weekend saying how serious is the president about this blockade? Is just as escalate to de-escalate in terms of rhetoric, and he doesn't follow through, and he, does the taco thing before the markets open. But then CENTCOM put out a statement explaining the blockade. So I do truly believe that there will be a blockade at 10 a.m., but I don't know what we look like this evening, especially given the fact that the Iranians say that they cannot access other ports, then they are going to go after Gulf ports in the region. So we could see a serious escalation in the next 24, 48 hours.
Is this the escalation we need to see to eventually de-escalate further down the road?
Most people seem to think that de-escalation is the logical consequence, whether it's because of the blockade or whether it's because of talks or whatever it is. Ultimately, increasingly, it feels like people are sort of tuning it out. They're listening to it in the background, but saying, okay, what's going to be in my next Sunday night evening? But people, when they take a look at the longer term, they say whatever happens, prices will come down, and ultimately we will resolve this issue by June, by July, by August. That faith is not held by commodity strategists. At the same time, I want to understand what the scenario analyses are from companies, from banks, from advisors in terms of how bad things could get versus how good things could get, and then figure out what the sort of intermediate could look like.
You sound like someone whose Monday morning started Sunday evening for the last 6 weeks.
Oh, you don't say. How about try a couple of years? I mean, it's sort of at a certain point, people get tired and they get whipped around and they see other people making money with information that they seem to have been getting from some other people. And there's a sense of like, well, why should I try to get ahead of that?
What's interesting, though, it's not just commodity analysts and experts that are saying prices are going to rise. The president did have this moment over the weekend in an interview saying that maybe gasoline prices will be a bit more elevated before the midterm elections. So he is acknowledging that gas prices might be a little bit higher for a little bit longer.
Equity futures this morning slightly lower off the back of this move in crude, higher by more than 7%. Coming up this hour, we'll catch up with Jason Draho of UBS. With markets retreating as earnings season kicks off, Steve Ricchiuto of Mizuho as hopes of a Fed rate cut this year are fading, and Bob Elliott of Unlimited Funds with crude surging back above $100 a barrel. We begin this hour with stocks adding to losses as Goldman Sachs fails to lift markets. Jason Draho of UBS Global Wealth Management writing, the start of first quarter earnings season should support our forecast for 11% EPS growth in the S&P 500 this year, with a price target of 7,500 in December. Jason joins us now for more. Jason, good morning.
Good morning.
How shaky is that outlook for earnings now?
Well, the guidance going into Q1 earnings season has been good. We've actually seen, kind of in terms of revisions upwards or downwards, it's actually been relatively optimistic versus other quarters. We've seen some good results from tech companies, some semiconductor companies. So the setup going in is good. I mean, we talked about, the high bar, perhaps for the market performance. The bar is high, but in terms of actually achieving that 11%, nothing so far we've seen going into the season will suggest that's at real sort of jeopardy. Again, we're making the caveat in terms of the whole Middle East situation, but abstracting that, the earnings story still looks very much on track.
This is anchoring pretty much everyone on Wall Street so far this morning. And I say pretty much loosely, forgive me, but the likes of Morgan Stanley, JPMorgan, HSBC, BlackRock, all saying something similar. It's an opportunity to buy. This from Morgan Stanley. Countries will find ways to solve a problem that is intolerable for the global economy, much like they did in 2022. Is this so bad it's got to get better and then you should look through it? Is it that simple? Because it feels much more complicated.
Well, in terms of kind of solving the problems, I think some lesson we learned from the pandemic era is that the supply chains, create, problems, but they also create opportunities. Like companies, the ability, the economy, especially the U.S. economy, to kind of solve the problems, have the price system sort of equilibrate again. I think it does it very well. And so the lesson from my takeaway from that experience is that don't underestimate the economy's resiliency. Now, the economic conditions today aren't as strong. The health of the consumer is not kind of strong. The fiscal support, it's not there. So a lot of reasons to obviously be more concerned. At the same time, I don't want to sort of doubt the ability of the U.S. economy to be somewhat resilient, through this whole situation. Resilient enough that, our forecast, I think we still feel pretty comfortable about ultimately by the end of the year, equities being up, about 10%.
One of the reasons that people seem somewhat optimistic, when I speak to a number of investors, they say ultimately all of these supply shocks will create the greater need to invest in artificial intelligence, the greater need to get bigger, to engage in deals, to create a critical mass and economies of scale. How much do you see the uncertainty and the ongoing supply shocks as only accelerating some of the capex that we've seen that have really driven some of the gains that we see not only in equities, but more broadly in the overall economy?
Well, the capex for AI, we're seeing strong numbers there. If you abstract from that, if you look at residential, non-residential, other investment, it's it's actually relatively weak. So we're not seeing companies saying we need to invest more necessarily in AI specifically. So from a near-term growth perspective, that's sort of not driving it. In terms ultimately of creating supply chain resiliency, I mean, this is now a story almost kind of going back a decade with, first with tariffs, with the pandemic. So I think you're going to see companies move in that direction. But it's hard to invest when there's a lot of uncertainty at this point in time. So I wouldn't view that as a key driver for the next, say, quarter or two to really lift U.S. growth.
One of the difficulties as people look to a potential upside, significant upside, 7,500, other people completely agree with you, is that there isn't an obvious hedge. We used to talk about bonds. We used to talk about gold. Nothing's really performed consistently. I mean, how do you think about a possible hedge to optimism that seems to be pervasive right now?
Well, it ultimately depends, what are you trying to hedge against? If it's ultimately oil prices going higher, commodity prices, that's an inflation shock. It's really difficult to hedge that. So you can look at things like oil or having exposure to commodities. That worked, earlier this year, like in March, we go back to 22, that would have worked in that time period. You can also sort of de-risk and have sort of less exposure overall. You can have less risk exposure in interest rates markets. We're saying stay in the front of the curve. We've no more than about the 5-year point. You don't want that interest rate exposure. So you can make changes at the margin, but ultimately an inflation shock is really, really hard to hedge. I mean, other than sort of de-risking significantly.
Are there any parts of the market that are prepared for serious escalation?
I mean, I think it depends. If you think of serious escalation, I think the front of the curve, pricing in, now this is a couple weeks ago, actually hikes seemed optimistic to me in terms of optimistic in the sense of the market sort of pricing the Fed to hike. Because ultimately, if you really get significant escalation, I think the market's transition from we treat this as an inflation shock and therefore the Fed has to hike to we treat this as a growth shock.
What is an escalation? From my standpoint, the status quo is bad enough. Really need an escalation from here. Physical market's really tight. Shortages are beginning to emerge across Asia. Europe is bracing for them to confront the same thing in the next month or so. I'm not sure. Do we need an escalation? What kind of escalation do we need? Just the status quo to persist. Where things are right now, for that to persist, week on week on week on week on week, you're going to see more damage to the global economy every single week.
That's logical. Yes, that's correct. Although Max Kettner over at HSBC is saying that actually it's the pace of bad news getting worse. And so if it's not getting worse as quickly as it was before, that's enough to keep people optimistic in the markets. I mean, just giving you a sense of what the register is right now on Wall Street.
Less bad.
Less bad.
Is good enough.
Good enough.
The line from Max Kettner of HSBC. Your conclusion too?
Well, in terms of escalation, really the key is, do we get oil flowing through the Strait of Hormuz? So status quo means whether military escalation or not, if you don't get that improvement, that's a problem. Because I think what the markets are assuming, what we're assuming is ultimately, as we go forward the next month or two, you get improvements. If that doesn't happen, yes, prices go higher, economic growth has to be sort of marked down. The markets are not pricing for that.
But then they're not pricing in what's going to happen in less than 2 hours today. There is an escalation. There's a blockade of the blockade. So even the little bit of oil that was getting out will be stopped.
Well, if you're talking about an oil tanker or two versus the 30 that we normally go through, I'm not sure that marginally makes a change. This is a question have to believe, will the administration do a blockade? There's also reports over the weekend that they're going to prepare to try and do sort of sweeping of mines. Could there be also...
That's good news.
A week or so from now that, all right, we'll do this, but we're trying to actually improve the flow of oil? I mean, so that's not something the market is talking about, but what is the ultimate plan for the administration? Ultimately, I don't think you want to have oil not flowing through. What the call is for is we want oil to flow through. And so you talk about a blockade, but ultimately, if you're working to prepare to increase military security so oil can flow through, that to me is a positive for the markets, which is not being discussed this morning from what I can see.
Jason, it's good to see you. Good. Thank you, sir. Thanks for dropping by. Lots to think about. Jason Draho there of UBS Global Wealth Management. Jason's right. There's always some tension with this. Financial markets will look at better versus worse, and for the rest of us, many other people will focus on good versus bad, and things are overwhelmingly bad right now in the Middle East, particularly for the people who live there. As for the better versus worse, can you make the argument this morning that things are getting better? I think that's hard. Can you make the argument that things are getting close to getting better? Maybe you've got some wiggle room on that front over the last week.
Or that the pace of news is less bad and that's enough to really get people excited that potentially there could be a resolution. And it goes to kind of Mike Wilson's point. If you have a rational look at the idea that economic destruction for everybody is probably not in anyone's interest, that things will work out.
We're not dealing with a rational actor in the Middle East.
This is something that people are looking at, and they say that the talks are evidence of some rationality prevailing. Look, either way, people are saying, if I miss out, that's a problem. I think the bigger point here is if you have an inflationary shock, there's no hedge against it. Stocks might end up being the best hedge for it because ultimately it might not be the bond market, especially if there's a fiscal offset. So people are hamstrung right now through a lot of different potential competing factors.
I also think the market is just happy that they met. there's no trust in this relationship, but there hasn't been trust in this relationship for decades. And the fact that they met, I think a lot of people view as a very good sign. Even though at home, those individuals that went over to Islamabad and met with the United States, members of the IRGC are saying, how dare you meet with the United States when they just killed Khamenei, the Ayatollah, and other prominent leaders in their country.
And the ceasefire, albeit fragile, the ceasefire is just about holding. Up next on the programme, we'll get you some morning calls, plus we'll catch up with Oksana Aronov of JPMorgan Asset Management as stress continues to build in private credit. That conversation just around the corner from New York City this morning. Equity futures recovering a touch. We're down by 0.6% from New York. This is Bloomberg.
I think we live in a world of higher, more volatile inflation. If the market believes that oil prices will be back down to $70 a barrel by December, then firms are going to see this as temporary. There are cracks in this economy. There's some other kinds of tailwinds that are holding things up.
That was Hollenhorst of Citi weighing in on the economic situation, focused on the demand side of the equation following a series of supply-side shocks, 3 of them over the last year, on trade, on labour, and now on energy. Equity futures this morning pulling back by just 0.6% on the S&P 500 in the face of this move in crude. A rally of more than 7% on WTI and Brent. WTI this morning 104, Brent crude Bramo at 102 so far this morning.
Yeah, so not necessarily at the absolute highs since the conflict began in the Middle East, but still rising significantly. And right now, it's sort of this uncomfortable numbness that we're seeing in markets. Or maybe people are getting increasingly comfortable that they can just look past this and say, there will be brighter moments.
Stocks unchanged on the year. Basically, right? I think we're down by 0.4%, something like that on the S&P 500 in the face of a major shock in the Middle East.
Some people could call this complacency. Other people would call this resilience. When you take a look at the composition of stocks that have changed significantly, you've seen a lot of volatility under the surface, the whole paddling duck that Amy Wu Silverman talks about. Ultimately, though, it does lie with the earnings. And do you see the earnings come in at the level that people expected? Right now, Goldman Sachs in pre-market trading down significantly at 1 point more than 4% in commentary from the bank, saying that the backlog of investment banking has decreased slightly. So a question of how much this really disrupts some of the pillars of this economic backdrop.
Let's play If You Told Me. If you told me at the start of the year all this stuff would happen. Javier Blas was on with us earlier. Fantastic on the commodity market, based out of London. And he said, if you told me all these things would take place, I would have thought even in the physical market, where crude has been trading in the 140s, that you'd expect, and in some places much higher than that, you'd expect crude to be trading north of 200 maybe. My guess, based on what's happened over the last 6 weeks.
I agree. It actually is shocking that Brent crude is just actually at 102 when it comes to, I know that's the paper market, but still, it is shocking because this administration has been jawboning. There's been verbal intervention. I do think the market does think that at some point, if it gets too painful for Trump, the idea of a Trump put, he will make sure that he could somehow get out of this. The thing is, this isn't like Liberation Day. There are multiple parties involved, and it's not just the Iranians, the United States, it's Gulf partners, and of course it's Israel.
The offsets have been pretty incredible as well. Unlocked a lot of inventories all around the world. The East-West pipeline, impressive from the Saudis. 7 million barrels,
yes.
Is that the number now?
And they're at capacity.
7 million barrels a day through that East-West pipeline has been pretty impressive too.
Yeah, I think that if we want to get a forecast, I would like to suggest some decorating in the surveillance studio. I think that we need to get a big dartboard. We need to have a number of different...
I thought you were going to park barrels of crude or something like that.
Well, actually, that's at home.
Okay.
It's good exercise for the kids. But ultimately, I think that we should just start throwing darts. And it's really the question of what gets on the dartboard that really is...
Blindfolds and darts, Bramo.
I think it might be actually more effective. I think that's the way to go.
Let's get you some morning calls. First up, Stifel lowering its price target on Meta, hedging for any potential impact from the war in Iran. Your second call from Roth Capital, raising its target on CoreWeave, calling it a pure-play AI cloud platform. And finally, Goldman double downgrading Best Buy to sell, warning higher memory costs could impact computer sales. That stock is down, and down hard so far this morning. Let's turn to private credit. The Federal Reserve asking major US banks about their exposure to the industry. The request following a recent surge in redemptions. Oksana Aronov of JPMorgan Asset Management writing private credit headlines have been able to hide behind war headlines. But this remains the epicenter of what we expect to be the next significant dislocation that will impact public markets. Oksana joins us now for more. Oksana, good morning.
Good morning.
Set the stage for us. How are the dominoes falling and how will they fall, in your mind?
First of all, let's start with the fact that this is the longest credit cycle we've had, I'm going to say in memory, because collectively here, no one has been through a longer one. It has lasted, you could argue, really since the end of the great financial crisis. We would have had one in 2020, but of course the Fed came in and kind of blunted that. And so there are a number of operators out there that probably should have gone under even back in 2020 that are still around. And today we have this entire ecosystem of private credit that has made it possible, has financed companies that probably would have struggled otherwise. We see that through the bad PIK activity. We see it through the rising defaults in the private credit sector, which hit a record last year. This year, the expectation was that they were going to ease because of lower rates, and that is not materializing, and so that's going to make that financing route more difficult. But at the end of the day, on the public side, what we're also seeing are downgrades outpacing upgrades. We are seeing, as a result of that, the CCC part of the market expanding, both sides of late credit cycle kind of dynamics. And the way this plays out is the way it always plays out. People want liquidity. And when they, obviously the theoretical concerns around valuations and liquidity in the private credit market are becoming real concerns, and remains to be seen whether they're justified or not. But people do want to get their money back. They cannot, right? The queues for redemptions have been met at best at a 50% level, in some cases only at a 10% level, meaning of the total redemptions that are in the queue of that particular operator. And when people can't get their money out of illiquid investments, they go where they can, which are the liquid public markets. And you start to see kind of selling begets selling as concerns mount. And you have a dislocation, which can be a very dramatic recession pricing type dislocation, even without a recession. And that, I think, is probably the playbook.
Let's build on this just a little bit more. Yeah. Where have we been building leverage? Because we've heard so much over the last 5 years that consumer balance sheets, household balance sheets are strong. We've heard so many times that corporate balance sheets are strong. Coming out of the pandemic, there was a massive transfer from the sovereign to those balance sheets, and that's why they're resilient. Where's the leverage been building? Where's the weakness?
So certainly some of these lower credit rated companies absolutely have more leverage, and remains to be seen, right? There's not a lot of transparency there. So, in the private credit portfolios particularly, so it remains to be seen. They are absolutely more levered, and this is how investors and managers and operators and companies get into trouble time and time again, certainly through leverage and liquidity concerns. There's also, the question I frequently get, which I think is related to what you're asking, is how does this become systemic? Because that's really what we're concerned about. And the reality is that we don't know that a risk is systemic until it becomes that. Because if we did, we would put guardrails around it, right? That's kind of the nature of what allows it to become systemic. And one avenue possibly for it becoming a systemic risk, not a huge base case for us, but certainly a possibility, are the insurers. Because the insurers have taken on a significant amount of private credit exposure. It is something like 18% of their overall bond exposure today. They are also, some of them are owned by alternative asset managers. And by the way, some unintended consequences of that, to the extent that these insurers provide guarantees in the muni bond market, we're seeing energy prepaid munis being impacted by that, because the third party in that transaction sometimes is that insurance company. So there are many kind of avenues for transitioning that risk from one epicenter of the market to a different part of the market. And the insurance could be that, because they're in a little bit of uncharted territory with more illiquidity and more high yield exposure, which has been the other headline over a number of years, right? As they operate in an ultra low environment, and in effect, to kind of match their liabilities, they've been taking on higher yield exposure.
Is this a private credit issue, or is this an AI disruption issue that is being masked as private credit?
You bring up a really important point, because by some estimates, as much as 40% of the private credit ecosystem is linked to software, AI, technology. And of course, to the extent that AI is coming for the lunch of some of these companies, their business models are we're not just talking about cyclical turnover, we're talking about, a business model that becomes obsolete structurally. That's one risk. And then, of course, there are questions around AI specifically, how much of that is really going to pan out in terms of, the investment resulting in the sorts of things that are being priced in. So absolutely, those things are interconnected.
The reason why I ask, and this is sort of the systemic node that some people who I'm speaking with are talking about, right now, the reason why markets are feeling good is because capital markets are wide open. People want to invest. They want to finance the AI revolution. what could cause people to pull back? Because that would be the ultimate lever that would create a real problem. Do you see any sign of that whatsoever?
There could be certainly a massive miss on the part of one of the hyperscalers. I think the thing to watch, and the reason this tremendous expansion in the hyperscalers and their capex expenditure hasn't really been an issue, is because it's been cash financed pretty much entirely. We're just now starting to see them resort and lean into the credit markets for financing and issue bonds and debt to finance it, but it's still such a tiny portion of their capital structure overall. And where it's growing, like Oracle, for example, we're seeing the effects of that in their CDS, et cetera. And so I think that's really the thing to watch, is how much debt and at what pace will they start accumulating it to kind of say, okay, maybe there's a red flag here, maybe not.
2 weeks away, Microsoft, April 29th. I think Meta's April 30th, and we'll look out for Alphabet as well, of course. Are we going to see that discipline kick in? Are they going to have to pull back on capex? They've said 1 million times in several different ways that the biggest risk for them is underinvesting and not over-investing. But it was easier to say that when the equity market was ripping and stocks were at all-time highs, and they were a big part of that story, particularly the likes of Microsoft. I wonder how hard it is to make that statement now, this morning.
And I think that the lead up to it is going to be all the companies reporting earnings ahead of it. How do they express the efficiencies? How much are they getting disrupted? And if they're not getting disrupted, then how does big tech justify all the investment that is only accelerating year after year in some of this technology?
Nasdaq futures down by 0.6% this morning. Oksana, good to see you.
Thank you.
Thank you for being here. Jim Zouter of Apollo might say take a walk or something like that.
Well,
did you hear him say that? He say take a walk, to get some fresh air.
I'm
Relax.
all for it. I'll do Pilates.
You know, bring it down, just a touch. We'll start the show later. We can all go and work out. We'll do Pilates and we'll come in much more relaxed.
I think it's great.
That's outside.
Right, you know.
They're allowed for it.
There we go.
Window.
Oksana, thank you. Oksana Aronov there of JPMorgan. Coming up on the programme, Steve Ricchiuto of Mizuho, as hopes of a Fed rate cut this year are fading. Plus, we'll catch up with Christina Kino. She's got your morning movers. Shares of Goldman Sachs falling as earnings failed to impress. That name is down by more than 4% this morning. That kicks off earnings season on Wall Street tomorrow. We'll hear from JPMorgan and others from New York. You're watching Bloomberg TV. Snap at a 7-day winning streak on Friday, but still posting the biggest weekly gain of the year so far on the S&P 500. Moves of 3.5 to 4% across the S&P, the Nasdaq and the Russell just last week. This morning, a slight pullback. We're down by 0.6% on the S&P. On the Nasdaq, we're down by 0.6% also. If you check out the commodity market, this is the gap higher we experienced overnight and into this morning as the blockade of the Strait of Hormuz begins. The US pushing this blockade in 90 minutes' time. Brent crude up by 7%, 102. WTI up by 8%, 104. And in the bond market, things are pretty quiet. Stable. Yields higher by 2 or 3 basis points. This is not a big move. We're up by 3 basis points at the front end of the curve to 382.
I do think that the direction is interesting. And what you're seeing increasingly is bonds selling off in tandem with stocks because it is an inflationary move. And this really is maybe one reason why people see perhaps more upside in stocks than bonds. Where is your hedge at this moment if the risk truly is inflation, as Jason Draho is talking about? And ultimately, how much is that anxiety hanging over some of the calls that we hear on Wall Street?
That positive correlation between stocks and bonds spooks people. And you're seeing it repeatedly, and it reminds them of 2022. And 22 was not a good year for stocks.
And we're seeing, again, inflation increase at the fastest pace going back since, guess when? 2022. That was the CPI that we got on Friday. And that was the increase that we saw. When we take a look at people's expectations for inflation, in the near term, it's creeping higher. Longer term, still well anchored. At what point does that change, and how much does that increase the spookiness of this correlation?
The good news, the Fed probably won't be hiking 500 basis points. I mean, that's the good news. I say probably because you never know what's going to happen in the future, but that's the base case.
And it's the pace of news that we're getting, and less bad is that the Fed is not going to hike by 500 basis points.
Less
so
bad
well done.
is good news from Max Kettner of HSBC. The opening bell about 60 minutes away. Let's get you some single names and morning movers. Christina Kino has more. Hey, Christine.
Hey, John. All right, let's take a look at Goldman shares this morning as that seems to be on the back foot. Goldman, of course, beating its own revenue, trading revenue for equities, coming in at $5.33 billion for the first quarter. But but of course, investors focusing on the disappointment from the fixed income revenue side of things. That came at just over $4 billion. Definitely what's dragging on the shares this morning. CEO David Solomon, though, calling the bank's performance, quote, very strong, but also warning of increased market volatility. Goldman, of course, kicks off Wall Street earnings this week. We have JPMorgan up next, due on Tuesday. Let's also take a look at some airline stocks, definitely in focus today as oil climbs back above $100 per barrel. You're already seeing the impact there right across the screen for the major U.S. carriers. Of course, some airlines potentially starting to feel the bite now. American Airlines raising its check bag fees again, and so it's charging now $50 for the first bag, $60 for the second, $200 for the third. So make sure you pack light. Now, let's round this off, taking a look at energy stocks this morning as well. Still very much in the green as we await the beginning of the U.S. blockade in the Strait of Hormuz, starting at 10 a.m. Eastern time today. Again, higher oil prices, just one part of the equation here. There's also the potential disruption to these companies' operations in the Gulf. ExxonMobil already warning of a 6% loss to its global production in the first quarter. Given those disruptions, we'll get more details on that when it reports earnings on the 1st of May. John.
Christine, thank you. Great work this morning. Appreciate it. Find more from Christine Aquino on the MLive blog on the Bloomberg terminal. Inevitable after a move like that in the commodity market that we'd see energy names up and travel names down. Charging for baggage. Do you want to do it?
Yes, I think so.
It's miserable boarding the plane because everyone is struggling to find overhead space to put their bags. And what's going to happen now? And then what do they do at the gate? You want to check in your bag for free.
Yeah, exactly.
I mean,
so
come on.
Everyone's going to do that. And then, of course, the enforcement of gate lights is going to be a really key issue because everyone's going to try to sneak on, to try to get their bag on first.
Well, the amount that American Airlines wants to charge, you're better off just buying some new items when you land. I'd rather buy a new outfit instead of packing a second or third suitcase.
You should charge for the basic fee, start with the basic fee, and then charge a supplementary fee if you want to bring in hand luggage. And you'll see what will happen. People want to take the hand luggage because of the convenience factor. No one actually wants to check in the bag. I'm not sure the disconnect here between the airlines and the people that travel on the airlines.
What it indicates to me is they're looking at every lever to potentially raise cash. So at what point do you start saying, well, if you want the nicely scented seats, then you can pay an extra $20 and it will smell like roses.
If you could guarantee me overhead space to put my bag, how much would I pay for that convenience?
Please do go on. How much would you be willing to pay?
Because I would be so annoyed if you took that away from me and I had to wait for the bag at the other end.
Okay, so how much would you be willing to pay? $200?
I think you could get business travelers to spend serious money.
All right, so maybe.
But that's why they sit in business.
You've heard it here first if you're an executive.
That's why they sit in business, because when you sit in business, you are guaranteed the overhead bin.
And they've already paid the money.
Yes.
Which tells you that they're willing to spend. Anyway, I've done this round before. I've done this round before. American Airlines needs to sort it out. You know, that's a separate conversation. Let's turn to the economy. Inflation data and Fed speak on deck this week as hopes of a rate cut this year continue to fade. Bloomberg's Mike McKee is looking ahead to all of that. He joins us now. Good morning, Mike.
Good morning, John. Listening to you guys, I think we need a new CPI category for airline baggage fees. And we'll keep track on how much they go up and how annoying it is. In the meantime, I'm sure you are, as I am, tired of saying we don't know what's going to happen next. The question with the economy numbers coming out this week is what's going to matter at this point, because we sort of know what they're going to tell us, and we also sort of know the Fed's not going to do much. Tomorrow we get PPI, and we kind of know where that's going to go. We know it's going to go up. It's just a question of how much. Wednesday import prices will be interesting because we haven't talked about tariffs very much in a long time, and it's always kind of a question of if you look at ex-petroleum, what is the impact on the exporters? Are they eating any of the tariffs? So far, they have not been. Other than that, not a whole lot that's going to matter to the Fed. But before the weekends and the blackout begins, then the Fed is going to be on the board. A lot of them talking this week, Myron. Today, Tuesday, Goolsbee, Paulson, Collins, and Barkin. We haven't really heard a lot from Paulson and Collins lately. So that'll be interesting. Mickey Bowman generally talking about regulation, and Michael Barr might be as well on Wednesday since he used to do that. But the one I'd point to is Friday. Chris Waller talking about the economic outlook. And of course, he's one of the swing votes in terms of whether you cut or whether you hold. I don't think Chris is going to come out and say we are going to be ready to raise rates. But I wanted to leave you with, since I don't have the airline baggage one, the chart to watch perhaps in terms of future inflation. And it's not gasoline. We all know gas prices are going up, and that's a pain. But diesel prices, this is the part that's going to get into the core of CPI, because it's going to get into shipping prices, it's going to get into trucking prices, railroad prices. And that's going to raise prices for everybody for package delivery, among other things. So that's one to keep an eye on as we go forward. Down a little bit last week, but probably going to rise again this week significantly.
Mike, thank you. Thanks for indulging us. Appreciate it. There's two things I hate about flag, and neither of them are flag. It's security, 1, and boarding, 2. And if they could experience 1 and 2, it would vastly improve the whole experience. And why they're doing nothing about either confuses me.
Well, the one thing that they're doing is increasingly saying, if you pay this much more, we can help you on both of these fronts. And that is the premium offering, and that is increasing the amount of their revenues and their profits. And how much do you see this in an increasing level as you see that K get wider and wider?
Yeah, but how many people line up when they say Group A or 1? Everyone, and then sometimes they
everyone has status now.
Yes,
you see that in the lounges
everyone
too.
has status. The other thing that really bothers me with airlines, when you wear a very tiny purse to keep just your cell phone and your passport in, they tell you to put it in your bigger duffel bag. They obviously know it fits. Why are you arguing with me to put it in this bag?
These are first world problems, so let's talk about real issues. Steve Ricchiuto of Mizuho writes the following. A robust macro environment suggests the Fed will not be in a position to cut rates this year. Therefore, long-term rates are likely to steepen the curve over the balance of the year. Steve joins us now for more. Steve, good morning. Good to see you.
Good morning.
You are the guy we call to ask the following question. What is everyone getting wrong? What is everyone getting wrong?
I think what everyone's getting wrong is the fact that this inflation is probably going to be stickier. I think it's been an ongoing and building problem in the system, and that's why I think the curve has the potential to steepen. The market's already basically taken out Fed rate cuts. I mean, there's a little probability of it in there. I don't think the market's really going to put in rate hikes. So the curve from here is probably going to move more dramatically from the long end of the curve than from the front end of the curve. And I think the steepener is really the big story. And if you're looking to get some evidence as to where you could have an inflation problem, look in the import price numbers this week, in particular the non-petroleum import prices. Tariffs are not included in import prices. However, last month through was the first month we saw a decided uptick in non-petroleum import prices. I think it went up by 1.2%. And I think there's a risk we get another upward adjustment here. So where we've been looking at the environment and saying, well, the economy is going to be softer, this will lead to lower inflation, I think the reality is the economy is proving it's not softer. Demand is still there. And you're going to start seeing that reflected in import prices.
I'm so pleased you've brought this up, because that's the biggest contradiction of the year so far for me. The consensus view at the start of the year was we get this cyclical rebound fueled by tax refunds and a bunch of other tailwinds. Then the consensus view is totally shifted. And the idea is now that you won't get any second-order effects on inflation because the economy's not strong enough to generate them. I'm struggling to put those two things together, and we've had that debate around this table several times. What do you think it's actually going to look like through the summer?
Well, I think what you're going to see is you're going to see 3% growth in the first quarter. You're probably going to see 2.5% growth in the second quarter, and probably something close to 2.5% growth in the third quarter as well. So you're looking at an economy that should be running around 2%, and you're running at least 0.5% to a full percentage point higher than that. So for the full year, you're probably going to be up about 2.6, 2.7% relative to a 2% trend. That gives you an idea of where the demand is. It's still there in the economy. And you look at refund check issuance, I mean, it's strong. We're up about $28 billion over the same week last year. And we're still at the point where we're starting to accelerate those refund check distributions. And that money is going to get spent. And that's what's adding to the demand side of the equation. Now, some people could say it's just going to wind up in the inflation components. That's fine. But that's why we're telling you the curve's going to steepen from the long end.
How much are people misunderstanding the average as being sort of the status quo versus a bigger divide? It can be true. Two things can be true at once. a great percent of the population can feel pretty terrible about the situation, both the labor market as well as inflation and just what it's doing to their paychecks. And there still can be a very big cohort of people that can still spend money to be able to get on the plane first and put their bags on so they don't have to worry about anything else. But I mean, this is ultimately what we're talking about. And that's the reason why Delta and American and United have good outlooks for the year, even though people are really frustrated about not getting on and getting their bag on the thing. I mean, this is essentially what we're looking at.
Well, go beyond the airline industry. You know, at bottom-up analyst expectations for 2027 are for north of 19% growth in earnings. We're at basically 15 to 16% for this year. So they're looking at it and saying, even as they've gone through this entire period of rising oil prices, they've been raising their 27 earnings expectations. Now, again, a little bit of inflation adds a lot more to the bottom line in earnings than people think. And that's a little bit of what's happening here. And that's how it gets embedded in the system. And that's why you have to be careful. And that's, again, why these inflation numbers are indices. They're indices of lots of different components because we see them moving in different directions. And you're right, different people will spend on different products based on their income level, and that will drive the index. And that's why we look at the overall index.
Could you see a credit cycle transpire even with otherwise pretty positive earnings and positive overall averages in the equity space, given the fact that you have a number of sectors where the consumer is more pressured, where potentially rates remaining higher is going to challenge them, and you have disruption?
Well, I think people are overplaying the K-shaped economy because you're not seeing it in demand. So I think that's a big part of the problem. Everyone wants to look for the recession call. Okay, that's what, because everyone wants to make the lower interest rate call because that makes everyone trades more profitable on the street. The reality is this is not a lower interest rate call. And therefore, you can magnify things like private credit to make them look like they can become a systemic issue. But in reality, if you just look at private credit, that's fine. But the reality is the financial markets are much bigger. So we're looking at an environment where IG issuance is expected to be up anywhere from $37 to $45 billion this week, I should say. That's a very, very strong performance for issuance. Nothing really sick on the calendar for today, but it looks like there's going to be some good calendar issuance. There's still a demand to buy yield in this environment. In addition to that, people are ignoring the fact that regional banks now are very, very healthy and looking to put themselves back into the loan market. So private credit grew so much because regional banks shrunk. Now you're in an environment where private credit's shrinking, and everyone's forgetting that regional banks are ready and primed to go out and make loans to a lot of these people and put them in perhaps a better financial position than they would have been before.
It's a crisis every spring at the moment, isn't it, Steve?
It's a continuous crisis. We've gone through 6 or 7 of these since SVB. And, you know, we keep on having these recession calls that pan out to be nothing. Private credit is just the latest.
Steve, it's good to see you. Thanks for being here.
Pleasure.
Steve Ricchiuto of Mizuho, the guy we called to ask, what is everyone getting wrong?
I love this. Or tell me how you really feel. I think that we should just have a segment. Tell me how you really feel with Steve Ricchiuto.
We'll do a roundtable with Oksana next time.
I think that would be good.
You know,
keep them together.
Ask them about airlines and get them to really fight. Up next, we'll set you up for the day ahead. Plus, Bob Elliott of Unlimited Funds joined us with crude surging back above $100 a barrel. Equities this morning down by 0.6%. The opening bell about 45 minutes away.
That's well within our capability, right? Blockading it and keeping control, interdicting ships, that's something we can do. I think we can stay far enough away that we're not really in constant range of Iranian attacks. It really comes down to the extent of how far we're willing to go and if Iran's going to try and disrupt us or not. I do think all bets are off. If we really see the ceasefire broken, I think markets sell off 2 or 3%.
I wanted to find time to have a serious conversation at some point this morning about the Gulf, and Grandma in the commercial break, do they get to keep the jacket? It's like the level of the golf discourse around this table.
You know,
the kids were
cute. That on air, so there you go.
Their kids were cute. I saw their children doing interviews. I don't even know who any of these people
That's
are, but
the
they're
par
children.
3 day. Yeah, ahead of the main.
Very
tournament.
cute.
I'm sorry, your problem was having hope.
It's like great disappointment. Anyway, let's talk
Lower
about
your
financial
expectations,
markets.
man.
They were never high. They were already low.
All right.
This is the market this morning. We're up by 7% on Brent and WTI. It's a gap higher. This blockade begins, according to the president, in 1 hour and 11 minutes' time. That's the move at the front end of the futures curve for crude, Brent and WTI. And you have to imagine if you take away those 2 million barrels of Iranian crude, that the physical market gets that little bit tighter as well.
Absolutely. And on top of that, it is not just the fact that this is a blockade and a blockade. As we've been talking about, there are countries right now who are going into really like existential moments because the final ships that they receive, no more is coming. On top of that, you have still the fog of what happened. You've been talking about the East-West pipeline in Saudi Arabia. What happens if the Houthis decide to get involved? There's tons of geopolitical risk. And is it being baked right in right now? Not sure all of it.
To equities at the moment, we turn equity futures at the moment negative just 0.5% on the S&P 500. Let's get to the trading diary for the week ahead at 10 a.m. Eastern Time. That's the time for the blockade to begin of the Strait of Hormuz. Coming up later this week, results from JPMorgan, Wells Fargo and Citi. That's tomorrow. We'll get PPI as well. On Wednesday, results from Bank of America and Morgan Stanley, plus the Fed's beige book. On Thursday, get a sprinkle of media/tech. We'll get Netflix earnings as well this coming Thursday. Let's turn back to our top story. Oil prices surging with President Trump's Hormuz blockade just over an hour away. Bob Elliott of Unlimited Funds writing, the longer gas prices are elevated, the more households must start to cut back elsewhere and prices rise more broadly. Bob joins us now for more. Bob, good morning. Good to see you.
Good morning.
What's the risk here of inflation becoming embedded, stickier and broader price pressure emerging in the months to come?
Well, I think the main issue here is that there's the immediate effect of gas prices at the pump go up. And for a short period of time, everyone kind of looks through that. You're like, it'll get resolved. I won't worry too much about it. But we're already starting to see, particularly in some Bank of America data, the lower income cohorts, lower income third, starting to pull back on discretionary spending. And that, this has only been around for a few weeks in terms of the price effect. That's going to start to permeate more broadly across the economy, not only because there's going to be a lot of spending on gas, but then we also have, the embedded prices through diesel fuel prices that are going to start to, go well beyond just the price at the pump.
So you see that stress migrating up to other income groups as well?
For sure. And I think one of the key issues here is we're sort of at an optimal point for an oil shock because we're also getting at the same time a bunch of these rebate checks, right? Tax refund checks. And that is those are two things that are offsetting each other. In terms of the economy, particularly for the lower income. But that's only going to last for on the order of weeks in terms of hitting people's paychecks and bank accounts. Once that wraps up, and then we have basically the roll-off of the Iranian crude that was sanctioned that's allowed to be sold, some of the Russian crude that was sanctioned that's allowed to be sold, and we've got another 2 million barrels off the market. Like, we're really coming to a stress point that's going to sit basically May 1st. It's going to be a lot of stress on the market with both higher prices and less spending power for households.
How does this translate in terms of market performance, given the fact that we've already seen a downgrading of a number of consumer discretionary sites, and a lot of people are expecting that any kind of growth is going to come from technology, from financials, which are a bit removed from some of those factors?
Well, when you look at overall growth expectations, I think it's a total consensus that we're going to have 2.5% to 3%. The previous guest was basically saying the same thing on a real basis. But then you look at household consumption numbers, even before coming into this oil shock, we saw household consumption over a 6-month time frame at 1.2% real. Add in 1 to 2 to maybe 3% inflation pass-through. How are households, which are just the backbone of the whole economy, how are they going to deliver enough real spending growth to meet those extremely high expectations? And remember, while a lot of the profits are going to come from from AI and other sort of tech-related endeavors, ultimately, the people who spend in the economy are households and the government. That's it, right? Otherwise, it's just trying to take money, who gets what share of the pie. And so if households aren't spending, it doesn't matter how good AI looks, it's not going to deliver the type of profits and revenues expected.
From an investment perspective, does that lead you to go into bonds, or is that not the answer anymore because the reaction function cannot come from monetary policy, given the fact that this is also has an inflationary tinge to it?
Yeah, I think one of the challenges is, it's probably not a time to go long bonds sort of in a traditional recessionary environment because so much of the effect is through the inflation side of things. So instead, looking at maybe being long bonds relative to stocks, right? The point being that the growth dynamic is going to be hit stocks harder than it is going to be hitting bonds. And so that's the sort of way to neutralize yourself to that inflation pressure and still make that bet on the very high expectations of growth that's in the market.
Bob, May 1, does the physical paper market catch up to the physical market?
Well, I think so. I mean, look, the true barrels being traded right now are trading at $140 a barrel, right, in terms of at the end of last week. And we're talking about bringing possibly up to another 4, 5, or 6 million barrels off the market by May 1st as those various elements roll off and if this blockade continues. That's probably, the old rule of thumb is $5 to $7 a barrel per million. We're talking about incredibly high spot prices that are facing this economy if this doesn't get resolved quickly.
Bob, it's good to see you. Thanks for breaking this down. Bob Elliott there of Unlimited Funds. At the end there, just this ongoing 1 month rolling disconnect between the front end of the futures curve and a physical market. And the closer you get to expiration, it's like the wake-up call. Hello, physical world, you've got a clear demand and supply, and that number is a whole lot higher.
That gap has never been wider. I mean, when that spot price reached $144 a barrel, it had never been wider versus the paper market. So at some point, you have to imagine it reconciles. At the same time, they're talking about talks. The pace of bad news isn't getting that much more significant. So people are getting a little bit excited.
And this blockade is real, according to U.S. Central Command. They're issuing notices this morning saying that a vessel going in and out, you are subject to interception, diversion, and capture.
Things could get tense over the next 24 hours, that's for sure. That blockade set to begin in 1 hour and 5 minutes' time. Tomorrow, we'll have numbers from JPMorgan and a whole host of other banks as well. Wells Fargo and Citi. The day after, you'll hear from Bank of America and Morgan Stanley. We'll break it down with the following guests: Brian Levitt of Invesco, Gerard Cassidy of RBC, Alicia Levine of BNY, and the Port of LA Executive Director Gene Soroka joining the program as well. Equity futures got into the opening bell negative by just 0.5% on the S&P 500. A lot of banks on Wall Street lining up with the same call. Buy the dip. Look through the tension in the Middle East. We'll see if that's the right call in the weeks to come. From New York City this morning, good morning. This was Bloomberg Surveillance.